Let's do a roll call. And so we have here Trustee Kelleher, Trustee Horowitz, Trustee Sun, myself, Castellano, and so Trustee Jennings will not be on for this part. Only she'll join us later. Okay.
Into closed session, yes.
Okay. All right. Well, with that, the first item is closed session. We will be moving to closed session for public employee performance evaluation pursuant to Government Code Section 54957B1, the position of Chief Executive Officer. We are estimated to reconvene at 9 o'clock. Into open session, there were no reportable actions in the closed session. I've been asked to remind speakers to speak directly into the microphone and that all presenters clearly state their names for the record and audio recording. Also, another note, because we do have one of the trustees calling in, today, all votes must be by roll call. So whenever we take action, I'll ask everyone by name what your vote is, so that that's very clear for the record. And with that, let's proceed with orders of the day. See, we have no time certain, so I'd like to request a motion to be made to approve orders of the day as agendized. Okay, a motion by Trustee Horowitz.
All second.
Second by Trustee Kelleher. And then if I could do a roll call vote for that. Trustee Kelleher.
Aye.
Trustee Orr.
Aye.
Trustee Sun.
Aye.
Trustee Horowitz.
Aye.
Trustee Jennings.
Here.
And then myself, yes. So that motion carries unanimously. Thank you.
Yes, that's right.
Okay, I'm going to ask for the board's approval to waive sunshine. Item 4C, discussion and action on adoption of resolution 9092 COLA rate for 415B qualified participants in the grandfather rule. Attachment 4C1 memo and 4C2 resolution were received late. If I can have a motion and a second to waive sunshine. Okay, a motion from Trustee Sun.
Second.
Second from Trustee Horowitz. Again, a roll call vote. Trustee Kelleher, please.
Aye.
Thank you. Trustee Orr.
Aye.
Thank you. Trustee Sun.
Aye.
Trustee Horowitz.
Aye.
Trustee Jennings.
Aye.
Okay, myself, yes. So that motion carries unanimously. Thank you again. We will proceed to consent calendar. So consent calendar today includes approval of service retirements, approval of board minutes, approval of return of contributions, acceptance of communication information reports, approval of travel conference attendance, and approval of administrative matters. Is there any items to be pulled from consent? And if not, then if I can have a motion and second on the consent calendar.
So moved.
Motion from Trustee Horowitz,
Second.
second from Trustee Kelleher. Thank you. Roll call vote. Trustee Kelleher.
Aye.
Thank you. Trustee Sun. Oh, I'm sorry, Trustee Orr.
Aye.
Trustee Sun.
Aye.
Trustee Horowitz.
Aye.
Trustee Jennings.
Aye.
And myself, yes. So that motion carries unanimously. Let's see, going on. Item 2, death and survivorship notifications. I'd like to ask for a moment of silence for those who've served the city and recently passed. Thank you, everybody. Item 3 on the agenda, investments. 3A, oral update from the CIO and Retirement Services, Mr. Palani.
Thank you, Mr. Chairman. I do have December flash reports here. The plan actually returned for the calendar year 2019, 13.6% versus a policy benchmark return of 13.8%, and a fiscal year-to-date return of 4.3% versus the policy benchmark of 4.9%. And that was the pension plan. The healthcare trust for the calendar year 2019 returned 15.2% versus a policy benchmark return of 15.5%, and fiscal year-to-date 5.5% for the healthcare trust versus a policy benchmark return of 5.4%. These numbers are, of course, through December 31st, 2019, and these are flash reports, so they're close but not necessarily accurate. With that, I'd actually like to, I'm happy to take questions. If not, I'd like to actually set the stage for the next 2 items on the agenda.
Okay, any questions? Okay, please.
Thank you, Mr. Chairman. So we have 2 education sessions this morning. The first one is on asset allocation, and the second one is on ESG investing. And I realize that about half the board, we actually have practitioners in the investment business, and in the other half of the board, we don't have investment people, trustees with investment backgrounds. And we will be asking the board to make very important asset allocation decisions in April. And so we are hoping that these education sessions will be useful for trustees. And we actually have, on the asset allocation side, we have 2 speakers this morning. And Jeremy Evnine, former police and fire trustee, was actually supposed to be the first speaker to kick it off, but I see he's not here. And I don't blame him. He's actually driving down from Berkeley, so he's probably caught in traffic. But I will introduce both speakers, and we have Ron Khan here. And Ron, if you don't mind coming up. And so in terms of flow, Jeremy was going to do a high level on asset allocation and educate the board on asset allocation topics. And Ron was going to go a little bit deeper into asset allocation, but I guess we'll have to just switch the order of the 2 presentations. I'll quickly give you Ron's background here before he can start his presentation.
Mr. Palani, I did forget an administrative matter that's necessitated because we do have a trustee. And perhaps, if you don't mind, I'll do that and then let you
Please.
do the introduction. I'd hate to do it in between
Sounds
the
good.
2 of those. Okay. So because we do have a trustee calling in, Trustee Jennings is participating via teleconference. I do have some questions to ask for Brown Act purposes.
No.
Trustee Jennings, I have 3 questions. Did you publicly post the agenda 72 hours in advance at the location noted on the agenda?
Yes, I did.
Are you in a room or space that is ADA compliant?
Yes, I am.
And is your room or space open to the public? And does the public have the ability to hear the proceedings and speak if they wish?
Yes.
Okay, thank you
There
very
is
much.
no one here, though.
Thank you very much for your indulgence, everybody. And then Mr. Palani, again, I apologize. Please
No
continue.
issues. Thank you, Mr. Chairman. So we have, as I mentioned before, Ron Khan here. Ron is a managing director and global head of systematic equity research at BlackRock. And he has overall responsibility for the research underpinning the systematic active equity products at BlackRock. And his service at BlackRock dates back to 1998 when the firm was, when he was part of Barclays Global Investors, which then merged with BlackRock in 2009. Ron is a well-known expert on portfolio management and quantitative investing. He has published numerous articles on investment management and along with Richard Grinold, authored the influential book Active Portfolio Management, which I still use as a reference guide from time to time. The two of them are the 2013 winners of the James Verton Award, presented by the CFA Institute. And Ron's book, Ron and Richard's book, the sequel, Advances in Active Portfolio Management, was published in December 2019. Ron is also the winner of the Bernstein Febosi Jacobs Levy Award for the best article in the Journal of Portfolio Management. And he teaches the equities half of the course, International Equity and Currency Markets, at the Berkeley Masters of Financial Engineering program. He has earned a physics AB from Harvard, from Princeton, and a PhD in physics from Harvard University. And he was a postdoctoral fellow in physics at UC Berkeley. With that, I will actually turn this over to Ron.
Thank you very much. It's an honor to speak to you this morning, and I assume you all have copies of the presentation. So what I thought I would do is talk a little bit about asset allocation, but really more about manager selection and how we think about who should be managing the pension plan and what are some of the implications. And to do that around what I set up as 5 myths that people may think about in terms of this topic.
I just wanted to, I'm sorry to interrupt, to let you know that we have your presentation available. So when you're speaking, if you want to particularly refer to a particular slide, and staff can manipulate the slide so that you can refer to them. If you choose to do that, you don't have to. You can make your presentation as you usually do. I just wanted to let you know.
Oh, fantastic, fantastic.
Great.
In fact, I will use the slides, so
Great.
so that's
you.
great. Yeah, you know, in terms of the performance of a pension plan that you're responsible for, the performance is going to depend on a number of different decisions. At a very high level, there's the strategic asset allocation, and determining that depends on understanding, in part, what are the liabilities that you're trying to fund, and how does the value of those liabilities go up and down with markets and rates, and that helps you determine your overall strategic allocation. Beyond that, there's a tax, so that's something you may decide over the next 5 years, this is your target, and then tactically, you might make a decision saying, we think the next year is a good time for equity markets, maybe we'll overweight them relative to strategy. It turns out to be what I'll describe later as a low breadth decision. You know, you kind of make one decision, and so it's hard to diversify that. And so it's fairly high risk. I'm gonna be more precise about that later. And then finally, once you have these asset classes, then you have to do manager selection within the asset classes. So there's a certain amount you're willing to invest in equities. How do you actually do that? Which managers do you choose? Do you choose index funds? Do you choose active managers? How do those, and of course, those also impact the overall performance. Now, I will say, and this goes to the introduction, that I'm mainly going to focus on manager selection within the asset classes. I think Jeremy will talk a little bit more about the high-level strategic asset allocation. So this is maybe a level below that. So let me go to the next slide and sort of the first myth which is certainly in the air these days, that index funds are you know, very desirable, and you know, all academic research would argue in favor of indexing over paying managers to try to beat a particular benchmark, that you're better off with low-cost index funds to match the asset class performance. And I just want to go into that in a little bit more detail. So on the next slide, I've listed a whole lot of basically academic arguments, and a lot of these arguments have won Nobel Prizes over time. So in terms of indexing, there's certainly a lot of academic research in favor of hiring index fund managers. The fact that you pay a very low fee turns out to be quite beneficial. And so there are these two theories. There's the capital asset pricing model, which is sort of a fancy name, but it basically says that the reason you earn extra money for investing in the equity market is that the equity market is risky. Not everybody wants to take that risk. If you're willing to take it, you'll earn an extra premium because other people don't want to own it and somebody has to own it. Now, there's another theory that says markets are very efficient. A lot of people follow markets, and there's very little you can figure out that's not reflected in market prices. So those are the academic arguments. There's another one which isn't up here, which is actually simpler, which is called the arithmetic of active management, which simply argues that the average active manager is the market. And some people overweight Tesla, other people underweight Tesla, but on average, people own things in sort of, market cap proportions. And so, the average active manager is going to underperform. Before fees and costs, they're going to match the market, but after fees and costs, they're going to underperform because of their fees and costs. And there's an enormous amount of evidence that says that that's true. Okay, so that's a lot of academic arguments in favor of indexing. On the other hand, there are arguments for active management, and so it's useful to understand those. At a high level, the idea that there's an opportunity comes from an old paper by Robert Shiller, who's a Nobel laureate in economics, and he pointed out something interesting. He said, stock prices are more volatile than they should be. That if you say, you buy a stock, you're buying the underlying fundamental economics of the company, and he showed that the fundamentals don't move around that much, and so the stock price really shouldn't move around that much, but it moves around a lot. All that says is if stock prices are too volatile, which everybody accepts due to his academic work, it says that sometimes they must be overpriced and sometimes they're underpriced. So it doesn't say you can successfully identify those, but it says there might be an opportunity. Then in terms of more specific ideas, there are several. And I just want to talk about two categories. There are ideas that I think of as broad and persistent. And those are either risk premia, sort of like the market. The market is risky, and so if you're willing to hold on to it, you get paid extra. Some people argue, for example, that value stocks, or stocks that are cheap, low price to earnings ratios, low price to book stocks, they're more volatile, and since not everybody wants to own those stocks, you might be paid a little extra to own them. There are also some work on behavioral anomalies. So we know human beings are irrational, but people have pointed out that we're systematically irrational. We make the same mistakes over and over again. And there are strategies that try to exploit those mistakes. So those are broad and persistent ideas. Now there's something that's much more straightforward, actually, and I call these more narrow and transient. It's that we might be able to do research and identify things about stocks that the market doesn't know yet. And so we may be able to make money by, the market doesn't understand this, but we figured it out, and we think this stock is worth more, we're going to buy it, and then the market eventually figures it out. Now, I call that a more dynamic type strategy in that the market figures everything out eventually. So if you build a strategy around informational advantages, it's very research intensive. You've always got to come up with the next idea because the market figures out the old ideas. If you're interested in risk premia, like value stocks should outperform over the long run, I call those more static strategies, not because your portfolio never changes, but because the idea never really changes. And as trustees, one thing we've seen is if something like a value strategy underperforms, and they've underperformed for roughly the last decade, value managers will tend to say, if you look over the long history, these things are going to come back. And so maybe we're underperforming now, but this is an idea that works. Just stay the course. If you talk to someone working on informational advantages and they underperform, they tend to come in and say, you know what, we screwed up. The ideas we thought would work didn't, and we're going to do more research and we're going to come up with new ideas. So as trustees, you're going to hear very different excuses for challenging performance at times. Okay, so one thing that's interesting about this, broad and persistent ideas of risk premia versus these more narrow and transient ideas is that the investment paradigm has really changed a bit. And so it used to be there were index funds and there was active management. And now active management is really broken into two pieces. There are strategies that are called factor strategies that use risk premia and behavioral anomalies to try to outperform. And then there's what we call pure alpha, where people use informational advantages. The thing you want to know about this is that the factor part has become more commoditized. And so if you want to invest in active strategies that deliver these risk premium and behavioral advantages, they tend to be lower priced than ones that are based on informational advantages. Okay, so what are the potential implications here on the next slide? So I think this idea that you should be in indexing or you should be in active management is sort of a false dichotomy. Most institutional investors have a blend of these two things. Some places active management is very attractive, other places it's less attractive, and most people look for some blend. And the other point, as I mentioned, that arithmetic of active management, we know the average active manager tends to underperform. So if you hire active managers, you have to have the ability to identify the better active managers, ones that are the top quartile, let's say. I tell my students at Berkeley, it's great to aspire to be an active manager, but it's not good enough to aspire to be an average active manager. If you want to go into this business, you have to have a reason to believe you can be one of the top active managers. Okay, let me move on to the next myth, which sounds reasonable, that investors need to seek out the active managers who can deliver the highest active returns. And by active returns, I just mean beat their benchmark. If it's a U.S. equity benchmark, to do better than the S&P 500 or the Russell 1000. And this is really a question of, like, who should you hire? Who are the attractive managers? And the key point here is it's not about delivering returns or historically having delivered high returns. It's how much return can you deliver per unit of risk that you're taking. Because what you really need is consistent performance. So if you look on the next slide, it's an interesting point that if you hire an active manager and they outperform by 10% one year and they underperform by 10% the next year, that sounds like at the end of 2 years you're flat. But actually at the end of 2 years you're down 1% because you go from 100 to 110, and then if you're down 10%, you lose 11 from there, and now you're down to 99. So after 2 years, you've actually lost money. If you've got a manager who's up 5% one year and down 5% the next year, similar thing, but you're only down 25 basis points after 2 years. So the volatility turns out to be something you've got to fight against. It keeps you from compounding returns in a positive way. So it turns out that the way to measure desirability of active managers is through what we call the information ratio. It's just the ratio of active return to active risk. And that active risk is that measure of how close are you to your benchmark. If you tend to be either up 10% or down percent, you're taking 10% active risk. If you're up 5% or down 5%, 5% active risk. So we can measure that, and we say, on average, how much are you outperforming? We would like to see people who outperform a lot relative to the amount of risk. And a rule of thumb, a top quartile manager, one that I said would be desirable, they have an information ratio of about a half. So if they're taking 3% active risk, they should be able to deliver 1.5% active return per year for the 3% risk. And so, in fact, what's going to be desirable for you is to find managers who deliver a lot of return per unit of risk, and then choose managers who are pretty uncorrelated with each other, so that they're not all down at the same time, but they outperform and underperform at different periods. So I have a graph on the next slide. It just illustrates this. This shows sort of the distribution of performance for 3 different managers. One has an information ratio of 0, one an information ratio of a half, and one an information ratio of 1. Now, all of these in this particular graph have an active risk of 2%. So if you look at the blue line, which is centered on 0 alpha, okay, so this is not a very desirable manager. Their average alpha is 0, but half the time they outperform, half the time they underperform. And if you say, how often are they going to outperform? It's about 50% of the time. As those curves move to the right, so the red curve, an information ratio of a half, you can sort of read off that they have an average alpha of 1%. On average, they outperform by 1%, and they, with 2% risk. You can see that less than half of the curve is to the left of 0. So if you think of the whole area of the curve as being 100%, the amount to the left of 0, which is now less than 50%, that's the probability that in any given year the manager is going to underperform. And as the information ratio goes up, the probability of underperforming goes down. So the more return you can deliver per unit of risk, the more consistent the performance, the less likely you're ever going to underperform. On the next slide, I have sort of the typical numbers for information ratios. The median is about 0, and 75th percentile, that's a top quartile manager, has an information ratio of about a half. So what are the potential implications for investors? When you're trying to judge the performance of managers, you really want to look at their information ratio. It's not about how much return you've delivered, but the return you've delivered relative to the amount of risk. And you want to build up a portfolio of active managers who additionally have low correlations with each other. I'm not going to, I'll show you a little bit of that, but not very much. Okay, let's go on to myth 3. This is one we hear about a lot, that the best way to invest in active managers is through what people call a barbell portfolio. So the idea of a barbell would be, let's get, on the one hand, an index fund, and the other hand, some really high-risk managers. And so the barbell is sort of these two extremes, either 0 active risk, which is the index fund, or really high conviction managers taking a lot of risk. And there's the barbell divided between index funds and active funds. And this myth is a little bit more about you've chosen active managers and how much money do you give to each of them? How do you sort of divide that up? And so first I'll go through a simple example, and then I have another example that's more realistic. So in the first case, let's say we've got a plan, they've got an index fund, they've got 4 uncorrelated high conviction managers. And so these managers each can deliver 1.5% active risk per year by taking return per year by taking 6% active risk. So they each have an information ratio of 1/4. So 1.5 divided by 6. And at the plan level, you're willing to take 1.5% active risk overall. And here's the best you can do in that case. It looks like you give 12.5% of the plan to each of those 4 managers. That's 50%. So 50% is in the active managers, and the other 50% is in an index fund. The index fund has 0 risk. So the index fund is really there to help you match the overall level of risk you're comfortable with. And it turns out that if you put that together, you get 1.5% active risk for the plan, and you should expect about 75 basis points or 0.75% active return per year. So the plan now has an information ratio of 0.5. Okay, fine. So then, let's go on though. Let's add another manager. So now we have a higher information ratio manager, but this manager doesn't take very much risk. So they can deliver 1% active return with 2% risk, as opposed to 1.5% return with 6% risk. So first thing we can do is, well, let's just throw that in with an equal weight, and we'll adjust the index fund, so we still have 1.5% risk at the plan level. And it turns out that instead of 0.75% return, you could expect 0.86% return. So things have improved. That's better. But actually, you can do even better. So a more detailed analysis, and I'm assuming all these managers are uncorrelated with each other, a more detailed analysis would say, actually, you want to put more money in that lower risk manager because he's got a higher information ratio. She has a higher information ratio. And in fact, instead of 86 basis points of active return, you can get up to 106 basis points of active return. So you can do much better by taking some money away from those high conviction active managers and giving this to the lower risk but higher information ratio manager. So it says it's less about the barbell and it's really more about how do we appropriately allocate based on return per unit of risk. So the theory says that actually you want to allocate your capital in proportion to information ratios and inversely proportion to active risk. So if something has less active risk, you'd probably put more money into it. It's less of a bet at the plan level. This result assumes that the managers are uncorrelated. The math is slightly more complicated if you take correlations into account. Okay, and in practice, we might deviate not only because of correlations, but also because of constraints and the targets you're trying to achieve. So I have another example, which is more of a real-world example where you can see this. So on the next page, yeah, here. So let's imagine that you have an MSCI ACWI benchmark. So this is the all-country world index. So we're talking about equities. And you've grouped them all together into this world equity index. And how would you choose between active managers and index funds? Also, not only as you look across all different types of active managers, but also as you change how much risk you're willing to take at the plan level. Now, one of the things that's going to come in, and you'll see this, so in the world of emerging markets, we tend to think there are more opportunities for active managers. We see managers do better, they're less efficient markets, and the emerging markets part of the ACWI benchmark, it's about 12%. So even though we have a lot of opportunities to find good active managers, we wouldn't put 100% of the plan in emerging market active managers because emerging markets are only 12% of the benchmark. So if you're at 100%, you're making a big bet that emerging markets are going to outperform developed markets. So you're on safer ground, at least you're taking less risk if you're more in that 12% of the benchmark is in emerging markets. So at least let's consider 12%, maybe 12% emerging market managers. So if you look at the results, we did a kind of detailed analysis of this We looked at all of the managers in the eVestment database, which is a database of institutional managers. And you can see, I'm showing you here how much money is going into managers who are in the acronyms here on the bottom left, U.S. large cap, international emerging markets, and ACWI. And so one of the things you see is if you only want to take a small amount of active risk at the plan level, then you tend to focus on the categories where it's easy to find active managers. So emerging markets, international, you tend to index the U.S., where it's a little bit harder to outperform. But as you start trying to take more and more active risk, then you start to, well, first of all, the line that looks green on the left, this is how much is in emerging market managers. And you see that steadily goes up until you get to about 30 basis points of active risk at the plan level, and then it starts to go down. You're willing to take more active risk, but now you can get emerging market exposure, let's say, through your international managers. So as you take more and more risk, though, you've got to take active risk in all of these dimensions. And the general result we see on the right-hand side, it shows your efficient frontier. How much active return can you expect to get as you take more and more active risk? And this is a number that keeps going up. The more active return you're willing to take, active risk you're willing to take, the more active return, but it's a diminishing scale. So it's not linear. Each additional unit of risk gets you less and less additional return. Okay, and on the next, the next slide, so you can see the active allocations and also what happens with indexing. So if you're willing to take if you're not willing to take any active risk at all, so you're all the way on the left, if you look at the chart on the right, how much is allocated to indexing, with zero active risk, it's all indexed. And so the emerging market index you can see is at 12%. That's how much emerging market is in that overall benchmark. As you try taking more and more active risk, of course, the amount you're putting in indexing is going down. So the question of how much active risk you want to take overall at the plan level is an important one. It's a measure of how much you might underperform in any one year, but it's also a measure of the opportunity you have to outperform and to earn additional returns to cover your liabilities. Okay, and the last chart shows, on the left-hand side, you can also see that as you take more active risk, you see a kink in there as once you get beyond 2% active risk, you're limited to lower information ratio managers who are still available. And so you're getting more return per each unit of risk, but it's less and less. And in this chart, we explicitly show the systematic piece. Systematic strategies sometimes tend to have higher information ratios, though lower risk levels. Okay, so what are the potential implications for investors on the next slide here? So I'd be wary of barbells. They don't always lead to the highest expected active return per unit of risk, which is once you've decided how much active risk you want to maximize that active return. Of course, if you target a very high active risk level, we'll only be able to choose among high active risk managers. But portfolios that have high information ratios and relatively low risk turns out can play an important role, and that's really the argument against the barbell. Okay, so the next myth is about high conviction concentrated portfolios. These are also popular these days, and there's something that sounds reasonable about let's find a manager who has really strong convictions and builds a really concentrated portfolio. So here's a very small set of stocks they know a lot about, and they have high conviction. And so we've already seen, and we've already discussed, that really what you're looking for is managers with high information ratios. And so the question is, how do managers manage to deliver high return per unit of risk? And it turns out that there's a law that governs this. It's called the Fundamental Law of Active Management, first described by my colleague and co-author, Richard Grenold. And he said, well, actually, the information ratio, the amount of return per unit of risk, is determined by three things. And they're all kind of intuitive. There's the investment skill that the manager has, the amount they can diversify across making different decisions, and the efficiency with which they build portfolios. So let me just talk about those for a second. So skill, very straightforward. Every time you make an investment decision, how likely is it that that was a good decision? So technically, it's the correlation of the forecasts you're making, like these 20 stocks are going to outperform by a lot, and then looking over the next year and see what happens. If half of them outperformed and half of them underperformed, that's not very much skill. So that's skill. But then diversification, this is what argues against these concentrated portfolios, is you actually, so skill gives you return. The thing that gives you return per unit of risk is to actually take that skill and be able to diversify across a number of different decisions. So the more different decisions that are in your portfolio, the more diversified it is, the more consistent your returns are going to be. So that diversification, sometimes we call it breadth, is real. It turns out to be really important. And then the efficiency is just how well does your portfolio actually reflect the ideas you have? And so now, your portfolio may not perfectly reflect your views because of transaction costs, because of constraints. Maybe you don't allow shorting, you don't allow leverage. Some stocks are just hard to buy. So there are reasons why you won't be perfectly efficient. Or maybe people are not good at building portfolios that don't know how to do a good job of trading off return against risk. So all of those things come into play. And on the next slide, I just have a couple of examples. The examples, I apologize, they might be a little hard to follow because they're numerical, and I didn't give you enough of a definition to know what all these numbers are. But here's a typical, if you'll bear with me, here's a typical stock picker. So their level of skill, the correlation between what they say is going to happen and what actually happens is about 5%. Now that sounds like a really low number, but it turns out to be typical for stock pickers. People you might meet who are active managers trying to outperform the US equity market. But now, my breadth, well, if I can follow 500 stocks, and every quarter, let's say I get new information on their earnings and fundamentals, I might have a breadth of about 2,000. So I can make different decisions on each of those stocks every quarter. And let's say I'm going to build a long-only portfolio with an efficiency level, this is relative to 1. I'm only 35% efficient. That's kind of typical for long-only portfolios. Hedge funds will do better. You put all that together, and it says you can get an information ratio of 0.78. So that's a top quartile manager. It's a low level of skill. This is because active management is hard. The market is fairly efficient, and so you have a small edge. But if you can diversify across a lot of decisions, you can actually deliver consistent performance. Now, I mentioned earlier tactical asset allocation. What if you're just trying to decide how much we want in stocks, bonds, and cash every quarter? And let's say actually you're better at that. So you've got more skill. Your skill level is 0.1 instead of 0.05. But you can't diversify very much. This is the reason that tactical asset allocation isn't that popular anymore, because you can deliver strong returns in one quarter. You just can't consistently deliver returns because you're not you're only diversifying over a very small number of decisions. So here, even with a higher level of efficiency, you end up with an information ratio of about 0.2. So not really top quartile. And stock picking turns out to be attractive in this analysis because you can diversify across a lot of different decisions. Okay, so the potential implications here, and this I think is the important point for you to keep in mind, that any successful active strategy has to have some winning combination of skill and breadth and efficiency. So there's more than one way to do it. And even though this fundamental law is a quantitative, it's a mathematical relationship, it applies to all managers, whether they're quantitative or not. And it says that every manager has to have some winning combination of these three things. And so as you think about active managers, keep in mind, how are they trying to put together a winning combination here? It might be kind of an equal focus on all of these things. Fundamental managers might say, I'm really just going to focus on skill. I'm going to do really well on a very small number of stocks, and they're betting that the skill they have is going to more than make up for the loss in breadth. And the question is, do you believe that that's the case? So as it says here, skill is the hardest to obtain. Breadth, in a way, sounds easy because you just follow more stocks, but it only works in combination with skill. So throwing in a lot of stocks you don't know anything about is not a winning strategy. Okay, so thinking about skill, breadth, and efficiency is I think, a useful way of trying to understand active managers. Okay, so the last myth I'm going to talk about is actually about quantitative active products, and that they're black boxes relative to what fundamental investors would do. And I think this sometimes comes about because fundamental managers are good at telling stories. So if you have a 20-stock portfolio, they'll tell you, why they like Tesla or they don't like Tesla. They'll talk about stocks that you know about. On the other hand, I think of them a little bit more as a black box in that it's in their head what's going on. So quantitative managers sometimes a little harder to understand, but everything is, it's actually an open box if you dig into it. So the difference between these two approaches, and I think you'll see both of them, in terms of investment ideas, fundamental investing is just limited only by imagination, and quantitative investing limited only by imagination and data. So it's quantitative investing is a data-driven approach. And these days, there's massive amounts of data. So there's data on many more things that you'd feel comfortable knowing are out there. In terms of data gathering, fundamental investing, they look at numerical, text data, they visit companies. Quantitative investors tend to mainly look at numerical and text data. They don't look at, they don't do very many company visits. And they differ in that fundamental investors tend to have concentrated portfolios. Quantitative investors tend to have more assets. That's really the biggest difference you'll see. And they tend to be team-oriented, whereas in the world of fundamental investing, it's usually the portfolio manager is the king. In the world of quantitative investing, it's a little bit more team-oriented. In terms of ideas, they're actually very, very similar, these two approaches. So on the next page, I've described two types of strategies. So these factor strategies that I mentioned earlier, that are broad and persistent, they're based on they're based on risk premia or behavioral anomalies. They tend to, there are 5 ideas that tend to show up in those strategies: value, Cheap stocks will tend to outperform. Momentum, stocks that went up over the past year will tend to keep going up. Small size, small stocks outperforming large stocks. High quality stocks outperforming low quality stocks, and we can measure quality a number of different ways. And low volatility stocks outperforming high volatility stocks, at least on a risk adjusted basis, so on a return per unit of risk. So those are what I've described as more commoditized factor strategies. All of those are related to either risk premia or behavioral anomalies. And then in the pure alpha space, where this is around informational advantages, those are driven by data. And I would say that we are in the heyday of these type of strategies due to the explosion of available data out there. What's called big data, machine learning, to harness those data. And in terms of types of data, I have it listed: text, search, social media, images, potentially video. There's just so much data out there now. And a lot of it allows you to do things that in a much better way than we could do before. And I'll just give you one example in the category of search. So active managers have long been interested in consumer sentiment. And we think if consumer sentiment is going up, people are more likely to go out and buy things. That's good for the economy. That's a good sign. And there's this classic data source that people have looked at for years, the University of Michigan Consumer Confidence Survey. So once a month, people from the University of Michigan, they make phone calls, they call landlines, they ask people some questions, and they come out with a number that says, is consumer confidence going up or going down? How does it relate to last month and last year? Here's actually a better way of doing that. We know now that if a consumer is interested in a big ticket purchase, let's say they're thinking about buying a new car, the first thing they're going to do now is they're going to go online and they're going to search. Let me look at what the new Ford is. What are the features? What do the reviews say? Which model exactly do I want? And we have data on searches, and the searches are geotagged, means we don't know the individuals who are doing the search, but we know which country they're in. Sometimes we know which state they're in. And so we have a sense of consumer confidence as measured by people doing searches for things they might consider buying. And publicly available data, it's much faster and more accurate than the University of Michigan survey, which comes out once a month. And so it turns out we can use this to figure out how is consumer confidence going up or down in different countries. Is the University of Michigan survey overestimating, underestimating? So that's just one example, but there are lots of examples where it's not about weird stuff, it's about ideas we were always interested, we can measure them better. Okay, I'm almost up here. So the last slide, just a decomposition of active returns. I kind of talked about this before. You invest in a product, you get that investment return at the top. There's a benchmark, and there's the active return. So the active return is, did we underperform or outperform our benchmark? It turns out we can break that active return into two pieces. What's coming from static exposures to those factors, the value, momentum, quality, and so on, and that pure alpha return that's coming from informational advantages. It's useful to think about, those are the two sources of active returns. You can now buy those separately. So the one on the left, the returns from average exposures to what are called smart beta factors, those are inexpensive. The pure alpha is more expensive, but I think that's actually where a lot of the more interesting work is going on in active management these days. So let me summarize on the last slide here. So I've mainly focused on choosing managers within asset classes and the key issues. The goal is to deliver consistent positive return, positive active returns. Most plans, they invest in active and index. It's not one or the other. Increasingly investing in factors and pure alpha and indexing. It's important for you and working with others to identify high information ratio managers. Those are the ones who are going to help get you to where you need to be. And you're going to allocate capital in proportion to those information ratios. You know, that's sort of on paper. There are some practical constraints around, you know, what is the benchmark invested in, how much active risk do you want to take overall, and how correlated are the managers. So hopefully that was useful, but a very quick overview of a lot of material.
Thank you, Ron. Mr. Chairman, I have a question.
I'm sorry.
I have a question
Yeah,
for the speaker. So, Ron, if you go back to slide 28 or 29, we spoke about two buckets of alpha, the static and the pure alpha, where you do a lot of research. So it seems like the pure alpha gets arbitraged away, and which is why we need to constantly do research.
Yes.
What's the reason for the persistence of excess return in the static, sort of the former French three-factor model? Though people who are following value would probably say it's dead, for at least in the last few years. But why are we still persisting with that?
Yeah, that's a very relevant question these days because value has underperformed for so long. So the arguments are either that these are risk premia, and so, you know, within the market there are some people who just don't want to own value stocks, and so if you're willing to own value stocks, you should get a premium for them, or they're behavioral anomalies. Where we're taking advantage of consistent mistakes that human beings make. Now, the one thing I would say is, and I'm going to maybe pick on value in particular, people who invest in these strategies say, you know what, if we look over the last 100 years, value has done really well, and it's outperformed by a lot, and its return per unit of risk is really high. It's actually much higher than the overall equity market. I would argue, looking forward, there's no reason to expect any of these things to do better than the market in terms of return per unit of risk. Furthermore, with value, you know, the world has also changed. So, you know, the idea that we can invest in, let's say, stocks with a low price relative to their book value, that's a classic value investing approach. You know, my team has a strategy that started in 1985, and in 1985, we did a lot with value. And in fact, just being able to access and calculate book-to-price ratios for every stock in the S&P 500 was an edge. We could do it, many people couldn't do it. Now, anyone with an internet connection can do it. Those kind of edges are gone. And so I tend to be suspicious of this kind of historical research that says, oh, wow, over the last 100 years, this has done really well. And you're testing it with technology that absolutely did not exist even 25 years ago or 50 years ago.
Great, thank you.
I have a question on information ratio. So when we select a manager, we can look at their past performance and then past risk exposure to calculate information ratio. But when we hire them, we expect them to duplicate that kind of performance. How do managers I guess I'm asking, statistically, how consistent are information ratio for a manager? Is there any empirical evidence to show that the managers are able to maintain the consistent information ratio and that help us to make a successful selection?
So unfortunately, the answer is basically no. So if you ask the question, if you just look at historical performance, you know, it's what's in the prospectus. Historical performance isn't much of an indication of future performance. If all you go on is information ratios, they may be slightly better than looking just at the returns themselves. But if you pick a manager with an above median information ratio historically, and you say, what's the probability that they're above median in the next period in information ratios, it's a little bit higher than 50%, but it's not like 80%. The highest numbers you'd see might be 60%. So there's a little bit of an improvement, but that's about it, which is why you really have to do more research than just the historical performance numbers. And so I do think that understanding, that mix of skill, diversification, efficiency, at least gives you a few more handles to try to measure, do we think this performance is going to persist?
Trustee Horowitz.
Thank you. First of all, thank you for your presentation. It's very comprehensive and informative, especially for those of us who are not investment professionals. But I do have a number of questions. In your studies, what percentage of active managers have outperformed passive indexes over the past 1, 5, and 10 years?
Yeah, so it's less than 50%. And I can probably get you the data. Different people do studies on this over different periods and different methodologies, but they all tend to have the same general result, which is consistent with that arithmetic of active management, that the average active manager underperforms. And the average active manager underperforms by about what their fees are. So you could say roughly 1% underperformance if you're looking at mutual funds. Might be a little different with institutions where the fees are lower. So that does tell you that if you don't have any particular skill at picking active managers, you shouldn't do it at all. It's a losing game. On average, you're going to underperform. So the idea of picking active managers, you have to have the ability to identify at least managers that are roughly in the top quartile.
So if the average active manager underperforms an index and information ratios show very little persistence year by year, by what means do we pick these mythical active managers who can outperform year after year after year?
Right. So first of all, there are managers who outperform year after year, but I think the way you have to find them is it's beyond just looking at historical performance. So historical performance by itself would not be a very good measure. And so, there are a number of other things you can look at in terms of what is the process that they're using, what kind of edge do they have. It's really, the real question is, they've outperformed historically. Was that luck or was that skill? And if it was skill, was it skill that they still have sort of on their own, or have lots of other people come into the same field? So I do think it's possible to do this, but I don't want to say it's easy or not without some risk.
It seems that an alternative strategy is simply to go with indexing and not to pursue the search for active managers who can consistently beat their indexes. You've given us no guide to how to select these managers other than looking for the ephemeral skill, breadth, and efficiency. We have no means, no mathematical means, no intellectual means to identify these managers. And in fact, indexing, there is a vast academic literature that illustrates the superior performance of indexing over active management. Is that not true?
I would say basically yes. I would not say that there's also some academic evidence for active management, but there's an awful lot in favor of indexing.
So I guess I'm a little disoriented by the title of your presentation, The 5 Myths, when it is certainly not a myth that indexing has been a very successful approach, and conversely, the search for active managers can be a hopeless and fruitless task.
Well, the only thing I would push back on that is that the upside of active management is delivering more returns for the plan. And so by going indexing, you are saying we're matching the asset classes exactly, and we're not going to try to outperform them. Now the other thing I would say is it tends to be somewhat easier to find successful active managers in certain areas than others. I haven't really focused on that here, though I mean, I could come back and talk more about that. But I would say we've just been through a 10-year period where indexing has been a phenomenal investment. Like all of the asset classes have gone up a lot coming out of the financial crisis, and it would have been hard to outperform indexing. If you expect that the next 10 years, and along those lines, if you think that the index, let's say U.S. equities are going to be up 15%, is it worth the risk to try to be up 16%? On the other hand, if you think U.S. equities over the next 10 years are going to be flat, if you can find someone who can deliver 1 or 2% more performance, that might be meaningful. So this is not answering your question into saying, here's the magic way of finding them, but I'm just saying there are some good reasons why you might consider it.
But it strikes me a bit like the example you gave of value investing. It's shown a history of episodes of great performance. Recently hasn't done so well. So are we going to see a reversion to the mean, or has something changed in the world?
Oh, I think a lot has changed in the world, and so I think an understanding of what active management might be appealing going forward is very much tied to how the world has changed. So if you think, I mean, I don't have to tell you how all the ways the world has changed, but I do think that has opened some opportunities. Now, I do think the active management isn't a static thing, or it's not something where, like, as an active manager myself, like, resting on your laurels because you did well the last 5 years, like, that's a terrible idea. It's got to be what's going to work over the next 10 years. How do we identify that? How's the world changed, and how do we make sure we're not caught up by it?
Well, thank you very much for your views. I would like to ask, I presume you were invited here by the CIO. I would love to hear a presentation by a financial academic who might be more in line of defending an indexing approach and enlighten the board upon their views. Perhaps they would title it The 5 Myths of Active Management.
Well, I would certainly like to invite Bill Sharp if he would actually come and talk about.
Would love it.
But it's certainly, I think one of my takeaways from Ron's presentation is that active management is very, very difficult. I don't think Ron's suggesting that we should do active management. He's just saying that it's a very difficult exercise. There is room for active management, but you have to watch out for these things. So again, we actually went into chapter 2 of the asset allocation discussion because Jeremy was not here, who was going to do chapter 1, and I just heard that he fell sick. And I hope it's the common cold and not the virus that's making the headlines these days. But hopefully he will be here next month to educate the boards. And we will have next month Dr. Myron Scholes talking to the board, who is the author of the Black-Scholes option pricing model and the 1997 winner of the Nobel Prize in Economics. So you can actually post these questions to Dr. Scholes as well. But again, I want to thank Ron, my colleague and teacher, and the fundamental law of active management, I think, deserves the Nobel, and I hope he gets it with Dr. Grinold someday. Thanks, Ron.
Great.
Thank you
Mr.
very
Khan,
much.
thank you very much. Thank you. We're going to take a 5-minute break. We need a little setup for the next agenda item. So let's be back, please, at 10:21. On item 3C, education session on ESG by Sarah Bernstein, Ofer Brook, Andrew Collins, and Verity Chugar.
Thank you, Mr. Chairman. I just want to introduce the panel and sort of give a background as to why we are doing this. So the city passed an emergency climate resolution sometime in the fall of last year. And the boards were asked to look at at the plant's fossil fuel exposures. And at that time, I did actually present the fossil fuel exposures to the board. And I also promised the boards that we will do an education session. Of course, it's entirely the board's decision on what direction we want to take in terms of ESG integration. But the point is really that calculating fossil fuel exposure is just one small part of ESG. ESG is much bigger topic than fossil fuel exclusion, as we call it. And also we're lucky to have Councilmember Davis here, who I guess who authored the resolution, the emergency climate resolution last fall. So we have, I'm going to introduce the speakers real quick. I have their bios. Andrew, I took yours from the website. So Andrew Collins is with the San Francisco Employee Retirement System. He's their new director of ESG investing. Well, new as in about 2 years old now. And Mr. Collins earned a BS in environmental engineering from Yale University and has over 10 years of ESG experience. And he comes to us first from State Street Global Advisors, where he served as an ESG expert and also spent 5 years at the Sustainable Accounting Standards Board. So we're happy to have Mr. Collins here. In no particular order, we also have Ofer. Ofer is a relationship manager with UNPRI, which is the United Nations Principles for Responsible Investment, the world's leading proponent of responsible investment. And Ofer leads the PRI's network and initiatives in Western North America. And prior to joining the PRI, Ofer was an analyst at the University of California Office of the CIO. And he also kindly put together this panel. And obviously he's a proponent of ESG. And as was all our panelists here. And then Sarah Bernstein is a PhD and principal from Makeda. And Ms. Bernstein is a seasoned institutional investment consultant and has concentrated on institutional investor ESG and sustainability issues for nearly 2 decades. And she has senior responsibilities across varying clients at Makeda and is a member of the firm's ESG investment committee. And Ms. Bernstein is also a member of SASB, Sustainable Accounting Standards Board. And last but not the least, we have Verity Chugar from BlackRock. She's a director in the ESG integration team at BlackRock, and she was previously an ESG strategist within the BlackRock Investment Stewardship team and has also worked at Alliance Global Investors. And she's currently the vice chair of the Sustainability Accounting Standards Board. So we couldn't have picked a better panel to educate us on ESG issues. And they've all been very generous with their time. And in fact, they're going to repeat this presentation to the Police and Fire Board on March 5th. So with that, I'm going to turn it over to the panelists. Thank you.
Welcome. Thank you all for coming.
Okay, thank you, and thank you for having us. Sarah Bernstein, I think I'll just jump right into the introductory presentation. So let's move to slide 5. I don't want to take up a lot of your time. If we can start on slide 5, just to give you a big picture overview of environmental, social, and governance investing. It encompasses a very wide range of approaches to investing, and combined, these numbers are from 2016 to 2018. The numbers, when they come out for 2019, will show even further growth in assets being managed with some version, some type of ESG mandate. Important element on page 6 of ESG investing is, in addition to just the allocation of assets and how you're managing and investing, is the proxy voting and engagement that comes along with your equity investments. Shareholder proxy resolutions related to ESG issues have gained a tremendous amount of momentum in the last, I would say, decade, even more so in the last 5 years. And in addition to that, around particularly climate issues, but around a number of environmental, social, and governance issues, there's been a growing number of institutional investor coalitions trying to work together to ask questions and forward less risk and more return on the ESG material risks that they face in the marketplace and in the economy. Page 7 just lists a number of typical common risks that you'll see folks paying attention to, identified under environmental and social and then governance issues. I'm not going to read them all off, but some of the governance ones have been actively looked at on the fixed income side and on the equity side for before the term ESG coalesced a lot of this and aggregated it. It would put on a important point, at this stage, which is what really is important across the number of issues that you can identify as environmental, social, and governance, is whether they're material from a financial point of view to your investments. So you can come up with all kinds of issues that either from an environmental point of view or a social issues point of view, but they may or may not be important to your risk or return as an investor. Page 8, and I'm trying to go through this fairly quickly. Please stop at any time and ask a question or interrupt me or at any time. The other thing that's evolved over the last number of years is data on ESG issues. It's no longer something that is just the purview of an active manager seeking it out on particular companies, but it's really become an industry in itself. And so there are very large data vendors like MSCI and Sustainalytics and RobecoSAM who are not just gathering the data, but organizing it and attempting to make it valuable to investors and investment managers. That process is still underway. A lot of it, it's not similar to data that, for example, is already required in disclosures by the SEC, so it's not standardized. More and more companies report, but there's still a lot of gaps, which means what do the data vendors do with that? They try and get the best estimates they can, looking at peers and other information. And just one data point here for the S&P 500, so even very large companies. In 2011, it was estimated about 20% of the companies in the S&P 500 index reported any kind of ESG metrics, and now that number is up to 80%. That's just large cap companies. Reporting data, just like for any organization, costs time and money and resources, and reorganizing how you think about your reporting function and accounting functions in your company. Along with just reporting data vendors, and there's many of them, have started to try and aggregate the information and score the data. So, and they're putting out ESG scores and E scores and G scores and S scores, trying to indicate whether one company has a better, for example, climate risk strategy and indicators than another peer. The one thing I would say about the scoring and the ratings these days is it's very different than what you'd find in, for example, the fixed income markets comparing a Moody's rating to a Fitch rating, where the correlations are about 99.99%. So that's a clear market signal coming from two very well-established on very long-term looked at metrics. In the ESG world, there's a lot of judgment. The result is that the correlation among vendors, one recent report showed it was between 44% and 70 odd percent. So, and there's good reason for that. There's judgment involved, there's less data, but there's also your particular perspective. In some ways you could think of it as one active manager's perspective on all these sets of companies compared to another. On page 9, we try to categorize the types of approaches broadly within all ESG investing into 3 buckets. Those that are focused directly on financial value, lowering risk, improving return across your portfolio or within a certain asset class. Those, and I think everybody on the panel is going to talk more about how they integrate key material ESG metrics into their process for analyzing and investing. On the far right, call it values rather than value, where your investors are concerned about a particular social issue, and they're changing their investment profile regardless of looking at the financial impact of that. That could be anything. Many types of investors. An easy one to think about is perhaps a religious organization which doesn't want, or anybody that doesn't want exposure to sin stocks or something, despite, which can be very important and mission driven, but is not necessarily being done with the financial implications of those, positive or negative, taken into account. And in the center, a new term of impact has come up, which tries to both get market returns at least, and at the same time deliver some quantitative impact on whatever the social or environmental issue is that you're focused on. So those are started, that kind of impact investments really started out in private equity and private sector. There's still a lot of debate about calling something impact in publicly listed securities. For example, if you just invest in a company, really in the market, you divest. Say you divest from a company and you think you'll get a better market return and have more correlation with your own values. Are you really, if you divest, somebody else, you're trading that stock. So somebody else buys a stock. The only time you're really having a direct financial impact in the public markets is in an initial public offering situation or a secondary where there's actually new money going to that particular company. Doesn't mean the companies aren't doing better or worse in what they're doing, but as an investor, you have a little bit of a different role than you do in the private markets. I don't want to take too much time, but this next page, page 10, kind of summarizes the same things I've been talking about and just organizes into when a competitive financial performance is required, which is really only in value or integrating ESG into your portfolio. The others, it's not always required, and you really have to look at the mandates and the strategies of the particular investment managers. And on the other extreme, ESG outcomes aren't always, in other words, a quantitative ESG outcome for your portfolio for integrating them. That is not the necessary goal. The goal is to reduce risks based on ESG issues and improve returns. From our point of view as consultants, we don't feel like there's any right or only approach to integrating ESG issues into how you think about your portfolio. We think they can be very important in terms of materiality. Makito works with clients, many public pension funds in the US, also endowments and foundations, which will have different fiduciary responsibilities and different missions. So last bullet here, integrating it, depending on how you do it, can be an incremental change to your portfolio, but depending on how much resources you want to put into it, it can be timely, cost both time and money, both board time, staff time, consultant time, and resources, which may be justified in what you get out of it, but I don't want to say that this, you're going to do this and not have any thought going into how you want to pursue it, if you should want to pursue something, and what you're going to do with it. The next page, page 11, gives more background. This could be an appendix. I'm happy to go through it if you wish. If not, I'll skip over it. It's really just sort of defining some terms that are commonly, and more acronyms for you to digest, that commonly are used in this field. And actually those are continued on the following page. So I'm going to move to the next section on what U.S. institutional investors are really working on and concentrating on today in integrating ESG issues. And on page 14, you see a picture of across the U.S., the 100 largest public plans and whether they have any clear ESG policies. And this full information on this. This is just what the Legal and General, who put together this, got from published on their websites that they could find. So folks might be doing stuff that wasn't right up there for them to find. It does show that there's a number of some of the largest in the country are very active in this area. On the right, I mention this because it's important to note that being active on ESG doesn't necessarily mean that you're reallocating $1 based on ESG. It can be that you're really working more carefully on your proxy voting and your engagement within the spectrum of your existing asset allocation and managers. On the bottom, you do see the types of negative exclusions that have been historically used, which is very different than what's sort of emerged more recently in terms of using a more of an integration and proxy and engagement approach, not just sort of a more, I would call, a blunter tool to hopefully achieve any goal you're looking for. On page 15, if you look at this list, it kind of looks like what you do every day on your investment portfolio. So ESG is really beginning to be looked at across the board, integrating it first and foremost if you're into your investment beliefs, adding or discussing having an investment belief that focuses on your ESG or your climate approach and beliefs about that from an investment point of view. Taking from there into your investment policy. Asset allocation, I would say for the most part today, at least in the US and in particular in public plans, is primarily more within asset classes. There's no big, I'm sure you all do, every 3 to 5 years, look at your overall asset allocation. There's work on that, but there's not a lot of just do something based on ESG to switch out of equities and into something else, or vice versa. Investment manager selection and monitoring, it's getting a lot more attention and usefulness based on the ability to actually have data and information to look at your managers from this perspective. And then engagement, I guess I'd put types of engagement into 3 categories. You all vote your proxies, but in addition to that, engagement is starting to occur with sort of an additional step in talking to your investment managers. In other words, doing monitoring with them and then following up with them and asking, well, why does your portfolio look like this? Or why does your proxy voting for us look like this. And in some cases, you might be in situations where, compared to other peers or other options, you might want to consider looking at other alternatives, given everything else equal. In other words, you know, we're not advocating in any way that you change anybody for less risk-adjusted return, or from BlackRock's presentation, lower information ratio and other measures of your overall portfolio impact. And regulators or governments, there's, again, primarily through larger institutional organizations that from Council on Institutional Investors to Ceres to PRI, I should start with them. They're one of the global leaders in this. Are really coordinating to a degree we haven't seen before historically, institutional investor asset owners to have similar approaches or coordinated approaches to issues where that wasn't the case 20 years ago. That can take the range of writing a letter that in support of, say, to the SEC, the Securities Exchange Commission, on their new rules on proxy voting guidelines, or when they asked for commentary on ESG and climate issues, that it's something these organizations would support, help write letters, and individual organizations and plans would support it by putting their feedback in. And company engagements, not going to talk about it a lot today, but I would say it's the most, can be the most time-intensive effort. And I think Andrew can give you a really good example of how they're doing it and managing it in a way that makes great sense for, and can be very exciting. But the caution is this is not something you take without doing it carefully and well thought out. So page 16, this, I think I can, we can kind of skip over this. I think things that are accelerating in the last couple of years are really looking at the portfolio level at climate change risk in some cases because it's legally required. But PRI will speak to what they're doing on that in integrating the TCFD regulatory task force on climate-related financial disclosure, just getting disclosure on issues that can be material to a certain industry and companies. And I'd say emerging is broader environmental and social and governance reporting on your portfolio and the asset classes and still in the publicly listed securities, so equity and fixed income. There's not enough data to make it sensible right now on, for example, private equity. But that's certainly beginning to take hold and look at, and the next page just gives some examples. I'm going to not go through this, but some of the larger plans and smaller throughout the country are the public plans. This gives some examples. It certainly doesn't summarize everything each of these plans are doing, but many of them have been active on ESG issues for over a decade and earlier. And San Francisco is one of them. I highlighted here, this isn't everything they do, but as far as I know, they were the first pension plan in the United States to start monitoring it at the individual company level. They're fossil fuel companies, so there's been lots of issues on fossil fuel and the energy transition that we're seeing take hold. But looking at both the financial risk and the climate risk at a company level as opposed to the whole energy sector is a very different way to approach. Should we divest from them? Should we engage? Should we monitor? And how do we do that? Okay. Page 19. Just summarizes some of the first steps we would talk to you about if you were interested in moving forward on doing something in this field. And so, depending on the board's interest, you could develop an ESG investment policy statement. Similarly, include an investment belief that summarized what you believe on these issues, or some of them are directly on climate issues, hot key issues that people believe are critical. You can review on an annual basis the results of ESG due diligence questionnaires for your managers as part of manager monitoring and selection. And you can consider various ways to expand your engagement. And the three, I don't want to do it today, but if that's of any interest, we could obviously come back and talk about the different areas for that, from working more with your investment managers, or on the regulator coalition side, or company level engagements. And another area of monitoring and reporting of interest is discrete periodic monitoring on climate risk and other ESG issues. A deep analysis of your portfolio. It's one thing to put out a carbon footprint of what you have versus your index, for example, versus doing a more thorough analysis of the climate risks and how they are exposed in your portfolio today. Those you may not want to do annually, but might be more on a time frame of when you do asset allocation studies every few years. The next couple pages, just for example, outline some ESG questions as a starting point. Those you want to develop, we work with clients to develop them to make sure they fit, and they are evolving over time. And evolving to make sure they're appropriate for each asset class. And I think I'm going to stop there and open up for questions. The next couple pages list a lot of details of various types of engagement and on investment managers and companies and regulators.
So Sarah.
Yeah.
This is Trustee Jennings. Can I say something?
Who's?
Yeah, of course, please.
Of course.
Okay. All right, thank you. Can't raise my hand here. I just wanted to state I appreciate, thank you so much for the presentation. It was very informative. And as a board, we're getting this as information, I assume, so that we can think about this as a possible plan to include going forward. Is that correct? I just wanted to confirm with our other, maybe with Roberto or with Prabhu.
Yeah, Trustee Jennings, this is Prabhu here. So the idea really is, this all came about because of the emergency climate resolution that the city passed. And personally, I've always felt that we should be looking at ESG as part of our investment process. But the first step to do that is really to educate the boards on what the options are, the definitions, and what it means. And so the panel of 4 speakers today is precisely to do that, is to educate the boards. And following this education session, either today or in a future meeting, the board can then discuss what we want to do, if any, about ESG.
And this is Jenny Kringle. I would just follow up and echo that, we're agendized for an education item today in terms of what you do with it. That deliberation should be at a different meeting.
And I was also hoping that we can hold our questions for the panelists to the end, so we can have them all speak, and then we have 15, 20 minutes at the end for Q&A.
Thank you. Andrew?
Okay, thank you.
Yeah, this one's working.
Good morning, everybody. Still morning here. So Probably thanks for the introduction. My name is Andrew Collins. I'm the Director of ESG Investing for the San Francisco Employees Retirement System. So happy to be here and just want to be a resource to you guys and sort of walk you through how we've thought about ESG issues and building out an ESG strategy for the plan. So start here really with this second slide, which is an overview of our plan in terms of when we were founded and our size, but really going back to our mission, which is like your mission, is to secure and protect and prudently invest the assets and ensure that retirement benefits are being paid in the amount that they're promised. And we always sort of start and end with that when we think about ESG issues, because ultimately, as fiduciaries, our board needs to make all decisions, including decisions around ESG issues, that are consistent with their fiduciary duty and not influenced by political, social, environmental objectives. So, always want to make sure, and that's part of the way we think, is always centering it around what is our ultimate mission, how do any decision we make, including environmental, social, and governance decisions, influence that decision. So we, again, right, think of ourselves as a fiduciary. We're also an allocator, like the plan here. So again, we have to think about decisions we make around ESG issues in the context of being an allocator to external managers, not managing our own money, and it's different decisions. And Verity we'll talk more about as a asset manager and making decisions directly about investing, how ESG issues are considered. And then thirdly, we're a diversified plan across asset classes, across geographies. As Sarah mentioned, ESG issues, how they manifest, how we can make decisions about them, how they're material do really depend on what asset class we're talking about. So it's not a one-size-fits-all solution for us across our whole portfolio. We have to be sort of nimble and cognizant that there's different considerations depending on the asset class we're looking at. The third slide here really just sort of summarizes what I just said again in more words. But what we've done to sort of codify our strategy is put in place what we call a 3-pillar ESG platform. And that's what I'll go into, is sort of the evolution of that and what each of those elements of that ESG platform are. Slide 4 begins our evolution over the last 30 years or so. Really beginning in 1988 is when SFRs first began to think about environmental, social, and governance issues. We called it a social investment policy at the time. And I think, our evolution is very consistent with the evolution of this type of investing and this lens of investing, moving really from things that were viewed as socially responsible or social investing to a more risk-based, what we now call ESG investing approach. And so we've had this policy in place since 1988. It's evolved over time. You can see that over the last 30 years or so, or the first 30 years or so, a lot of the work that we did was really focused on what we wanted to exclude from our investment universe. So these were sectors or particular companies that we felt posed a particular risk to us or posed a social risk to being invested in. We didn't want to provide capital to those types of industries or companies. So 1998, we divested from the tobacco sector. In 2006, at the height of the Darfur genocide, we divested from companies that were operating in Sudan and partnered with the Sudanese government that was perpetrating the genocide. In 2016, we said we weren't going to invest in civilian firearms manufacturers and ammunition manufacturers. In 2017, we excluded thermal coal companies, so coal that's being used for energy purposes from our portfolio due to the risks that we saw in that sector. Moving forward to the last few years, and so I joined the plan in 2018, and we can go to slide 5 here. We really said, we've done a lot of work over the last 30 years or so. Let's think about how we can codify and formalize our ESG strategy and platform. And so we established an ESG department. I was brought on board. We put in place an ESG platform. We updated our ESG policy. And we really started to think about all of these different issues, perhaps more from a risk-return perspective, rather than a sort of binary perspective of we are okay being invested in this sector, but not okay being invested in this sector. So the initial focus was really on our fossil fuel investments, due to a lot of concern globally about global climate change, as well as secular changes that are underway in the energy sector. As Sarah described, we put in place this risk-based framework that really tried to identify oil and gas companies that we felt like posed particular investment risk to us, and really focus in on those companies. We made a lot of steps to join investor initiatives and coalitions like the Principles for Responsible Investing, as well as the Climate Action 100 group, the 30% Coalition, which advocates for more women and underrepresented minorities on corporate boards, and a few other collaborative initiatives with other institutional investors. And we really kicked off that process to say, let's begin to think about how ESG issues matter to each of our different asset classes. In 2019 was the first year we did our inaugural PRI report. So this was the first time we sort of formally did an assessment and report on our ESG practices across our whole plan. We further integrated ESG decision-making into our due diligence process for all the managers that we bring on board. So Sarah provided some of those example questions that you can ask to your external managers. We began to incorporate these into every underwriting decision and sort of set up the expectation to our board that they could expect to see these considerations as part of any recommendation that we made and brought to them. And then we really ramped up our engagement efforts with underlying companies in our portfolio. So sitting down with boards and company management to discuss with them how they're managing issues like climate risk, gender diversity, executive compensation, and I think took something that had always been in our policy as aspirational or something that we felt like it was important to do, but really now put those resources towards having those conversations. And as Sarah said, it does take a lot of resources to do that and a lot of time. So I think the time was right for us to say, we now have 2 staff members, myself and an analyst. We can have those conversations with those underlying companies. So more to come this year. Nothing to report yet out of what we're doing, but that's sort of what we've been up to over the last couple years. And slide 6 here sort of organizes all of these different types of activities into these 3 pillars that I mentioned. So that first pillar is really about what we call active ownership. So this is about engaging with underlying portfolio companies that we hold to talk about how ESG issues can affect their long-term performance and viability. And we do this in conjunction with other investors and really feel like there are unmanaged ESG risks that are affecting the performance of overall financial markets. Our incremental ability to reduce that risk, to have companies themselves manage these big systemic risks can hopefully improve the overall performance of the market, improve beta performance. Our second pillar is what we call ESG investment management. This is about our efforts to engage with our external managers on ESG issues. We always like to build really long-term relationships with our external managers. Part of that process to onboard a manager is make sure that we're comfortable with the way that they invest, the way that they think about the world. So we've begun to incorporate an understanding of their views around ESG issues when we screen our potential managers, and as we continue our relationship with our existing managers, to make sure that they're casting a really wide net when they think about risk and opportunity over different time horizons, and that they do have a viewpoint on ESG issues, and that they're able to articulate how they're incorporating that into their investment management process. And then the third pillar here is what we call ESG collaboration and communication. And we feel like it's really important as a long-term investor with a very long time horizon that we're able to communicate externally to the market our viewpoints around what matters to the long-term success of businesses and the long-term success of the economy. So this manifests in a few different ways. It's through our policies, our investment policy statement that includes consideration of ESG issues that goes out to any of our managers or potential managers. It includes our PRI report and other public reports that we make to our beneficiaries and to the public. And it includes our membership in initiatives like the PRI, the 30% Coalition, Council of Institutional Investors, to band together with other major institutional investors, other public pensions, to really make clear that there's a collective mass of investors who are fiduciaries that care about these issues and that want them incorporated into the way that our money is being managed. I'm going to probably just stop there, just given the time, and the next slides really dive into each of these pillars and talk about specific operational areas that we've done under each of these pillars and really break it down. So happy to answer questions at the end about any specific areas there, or certainly follow up with staff or the board on any of these issues.
Great, so let's just keep moving it along so we make sure we have time for Q&A at the end. Hi, everyone. It's a pleasure to be here. My name is Ophir Bruck. I'm with the UN-supported Principles for Responsible Investment. Get into who we are and how we support asset owners with integrating ESG factors into investment decision-making. I've got a few slides ahead of that I'll quickly cover. First of all, I'd like to just commend you for making time on the agenda for ESG education, primarily because there still exists a lot of competing definitions, misconceptions, myths. So we're here to hopefully bust some of those myths, help get everyone on the same page. Even within boards, we find that individual board members will have different views on what's important to them. What does ESG mean to them? I know Elaine's been at this for a while. Hi, and Prabhu, just commending you as well for bringing this to the board, so we can kind of help, again, get everyone on a similar page so we know what we're talking about, and then from that point, the board can make an informed decision on how to move forward. So with that, you've heard from Sarah and Andrew about a little bit about the what. What is ESG? What is responsible investment? A lot of definitions out there. In our name, the Principles for Responsible Investment, those latter two words, responsible investment, it's in our name. So slide 4 gives a very broad definition here of responsible investment. And you'll see that coming up in just a minute here. So it's a strategy and practice, right, to incorporate environmental, social, and governance factors in investment decisions and in active ownership, what has been referred to here as proxy voting and engagement. So this is a catch-all definition. It's a broad umbrella under which we've heard some other terms like ESG integration, right? Incorporating those financially material ESG factors into your investment analysis in order to get a better sense of how these risks are informing the valuation of a company, and so you can apply a proper discount and ultimately assess an asset for long-term ES&G risks. Other things that fall under this broad umbrella include socially responsible investing, which you heard more, negative screening, divestment, impact investing. How are we thinking about generating positive environmental and social impact alongside our financial returns? And others as well, mission-related investing, and the list goes on. So what I'd like to make sure we keep our focus on is this term that you've heard a couple times now, financial materiality, right? What are those ESG factors that actually drive risk and return and are relevant to a given industry, a given sector, a given company? You'll hear more about that from my colleague Verity in a moment, but if we flip to slide 5, touching on why invest responsibly? You know, why would the board dedicate time and resources to this? And so, starting with these sort of four primary reasons. A, materiality. So, so I'll take a step back. There's a very quickly growing academic body of research and industry research as well that's really showing the relationship between ESG factors and financial performance, both at the company level, at the asset level, and at the portfolio level. And so if we now understand, if the research really shows that this is the case, how as investors do we prudently incorporate these factors into our investment decision-making to execute our fiduciary duties, if these do really drive risk and return? How should we think about them? So materiality is one reason you would invest responsibly. Another is market demand. We're really seeing a sort of an explosion, if you will, or mainstreaming of responsible investing practices. Some of that was touched on. Just to throw a few figures at you, you know, over in the U.S., over 70% of the 50 largest investment managers are signatories to the UNPRI. We have, you know, as you'll see in a moment, over 2,900 signatories across nearly 60 countries that collectively represent over 90 trillion in assets that have signed on to the principles for responsible investment. So this is coming into the mainstream, and now that it's firmly here, the question is, how do we incorporate this prudently? The third is regulation. So what we're seeing as well is a proliferation of policy and regulation globally and in the US that is either encouraging or mandating the incorporation of ESG factors into investment decision-making. And I'll touch on that in just a moment. So maybe I'll touch on that now, actually. So on slide 7, you'll see a steep upward trend here, and this is so the PRI has tracked over 700 policy instruments and market initiatives worldwide across the top 50 economies that either support, encourage, or require investors to consider ESG factors in decision making. So this includes things like ESG integration requirements, so laws that are actually mandating pension funds in certain countries to incorporate ESG factors into their investment decision making. It includes stewardship codes that are more voluntary initiatives, as well as corporate disclosure guidelines. In the EU, the non-financial reporting directive, which mandates that companies in the EU disclose their sustainability-related risks and how they're managing those. So 97% of these policies, these 700 policies, were adopted after 2000, and over half were adopted after 2013. 80 of these were adopted in 2019, last year. So we're seeing a real uptick in regulation of pension funds globally. In the US, a good example, the state of Illinois adopted what's called the Sustainable Investing Act, which is mandating that all public funds in Illinois adopt an ESG policy. We're seeing some policies in California as well, mainly focused on CalPERS and CalSTRS in the University of California, my former employer. But the point here being is that this is also a driving factor of why fiduciaries should think about responsible investing. So moving along to slide 8, I mentioned the growing academic body of research that is really digging into this question of what is the relevance of ESG factors for financial performance. So a few key studies are listed here. On the UNPRI website, we also maintain a repository of over 900 academic studies that you can search through by category to get a sense of what's out there in terms of the research. And you'll see on the left here a meta study by the University of Hamburg that took 2,000 underlying studies which look at the relationship between ESG factors and financial performance. You'll see that 63% found a positive link between a company's ESG performance and its financial performance. And this is across a range of measures, including operational performance, cost of capital, stock price, and stock price volatility. 10% found a negative link. The remaining 27% found no impact at all. So that's a bit of background. You've already kind of heard a little bit about the trends here. I'd like to focus the rest of my time on what the PRI is and what we do. So if you flip over to slide 10, thank you. So the UN-supported PRI, Principles for Responsible Investment, was developed in 2006 when then Secretary General Kofi Annan gathered a group of global institutional investors at the UN and created a set of 6 principles that together form an overarching framework for how to integrate ESG issues into investment decision-making, how to be active owners, and how to drive, how to basically achieve a more sustainable global financial system. And in April 2006, we were officially launched at the New York Stock Exchange. Since 2006, we've grown to become the world's largest responsible investment initiative. I mentioned earlier, over 2,900 asset owners, investment managers, and service providers make up our global signatory base. They collectively represent over 90 trillion in assets, so a significant portion of the world's institutionally managed assets. We are supported by the UN. 2 UN permanent bodies have a permanent seat on our board. And if you'll flip over to slide 11, you'll see the PRI's mission statement and the 6 principles themselves. And you'll see that our mission statement is quite broad and quite ambitious, right? Achieve a sustainable global financial system. And we believe that such a system is a necessity for long-term value creation. This is important to long-term universal asset owners such as yourselves. So we work to achieve this by encouraging adoption of the principles and collaboration in their implementation, by fostering good governance, by fostering integrity and accountability within financial markets, and by addressing obstacles that exist within the financial system to its long-term sustainability. So the 6 principles here, I'll quickly run through them. The first, and again, these are high-level principles. Think about them as a menu of options for how you as a fund would integrate responsible investing into your decision-making. So the first is a commitment to incorporating ESG issues into your investment decision and analysis. The second is that you will be active owners. You will vote your proxies and you will engage with companies where you see that there are financially material ESG issues. The third is that you'll seek appropriate disclosure on ESG issues from the entities in which you invest. So data was mentioned earlier, and so we know that institutional investors play a key role in garnering the data that we need to make informed investment decisions. Principles 4 and 5 really speak to collaborating with peers, as Andrew mentioned SFers is doing, as well as promoting the principles, which Andrew being here today is doing and the rest of us are doing. And 6, principle 6 is about reporting. So our entire signatory base reports to us annually on how they're incorporating the principles into their investment decisions. And what that does is it creates a plethora of data for asset owners such as yourselves to be able to incorporate into your manager selection, appointment, and monitoring process to understand how managers in your portfolio are integrating ESG factors into their investment decision-making. You can look at their PRI reports to do that, and you'll hear a little bit more from Verity today about how a manager is doing so. Slide 12 is our governing board, just to give you a sense of how we're governed. We're very much led by asset owners. 7 asset owners sit on our board, including the chair of the CalSTRS board, 2 investment managers, and 1 service provider. And that service provider is Sustainalytics, an ESG research provider. So if you'll flip to slide 14, you'll see a breakdown, global breakdown of our signatory base. Geographically, the US is the largest single signatory base, largest capital market, over 550 signatories here. And slide 15 is a list of the US asset owner signatories. So what asset owners, including public pension funds, have become signatories to the principles for responsible investment. SFRs is one. Other municipal funds, Los Angeles City, Seattle City, and then you've got county plans and state pension plans as well that are signatories throughout the country. So what does it really mean now to be a signatory? Okay, so you've signed on. There are 2 things that we ask our signatories to do. One is to report annually, with the first year being a grace period. And the second is to adhere to a set of minimum requirements that are listed on slide 18. So if you'll flip to slide 18. And signatories have 2 years from their first reporting cycle to adhere to these minimum requirements. The first is to have a policy that covers the firm's responsible investment approach. The second is to have staff that are responsible for implementing the policy. This doesn't mean a dedicated responsible investment professional, but just a clear line of responsibility there. The third is senior level commitment to responsible investment and accountability mechanisms for it. And we capture all this information through the reporting process. Now, those are the requirements. What are the benefits? So we see ourselves as sort of a 3-pronged organization, or at least I like to think of us as an investor collaborative initiative, a platform to come together with peers, to learn from peers, and to exchange knowledge on best practices on responsible investment. The second is a standard setter. So we're really putting out best practices and guidance into the marketplace, the tools and the resources in your hands to figure out how to do this. And the third is I like to think of us as sort of a low-cost ESG consultant. So, Sarah touched a little bit about, what kind of resources are required for implementing this at the plan level. It's really going to vary. Some plans like CalPERS have a dedicated team. SFRs has dedicated staff. Others don't. We have, the city of Seattle has, I think, 4 investment staff. So each fund is going to have their own unique context and resources, and some will lean more on their consultant. Makita is a PRI signatory. They help with reporting for certain signatories. And so there's a real, I like to think of being a PRI signatory as sort of a gym membership. You can have the membership, you can never go, you can make use of the personal trainers there. You can think of me as your personal trainer. I spend a lot of my time supporting our signatories with making use of our tools and resources. And I'd like to touch really quickly about what some of those tools and resources are. So if you'll flip over to slide 21, I'll run through the next few slides and then hand it over to Verity. So slide 21 is our Fiduciary Duty in the 21st Century program. This is a program that was developed in 2015 that really dug into this question of what is the relevance of ESG factors to fiduciary duty, and how should fiduciaries ultimately think about this. So we launched our final report last year, and we really concluded that if ESG factors are indeed financially material, which we now know they are, then failing to incorporate them into investment decision-making, into investment strategy, into investment policies, we see as a failure of fiduciary duty. Now, that's strong language, but if you read the report, you'll find out why we strongly believe that and take that position. Slide 23 is an example of some of the resources that we have for our asset owner signatories. guidance on how to incorporate ESG into your investment strategy, how to develop an ESG policy, how to incorporate ESG factors into your manager selection, appointment, and monitoring, how to engage with your investment consultants on ESG. Slide 24, you've got ESG due diligence questionnaires off the shelf to be able to incorporate into your manager selection process. Slide 25, resources dedicated to climate change, a tool that allows you to upload your listed equity and fixed income portfolio and stress test it against various climate-related scenarios. Guidance on how to how to think about strategic asset allocation and how climate change and the transition to a low-carbon economy might impact asset classes on a forward-looking basis. Also, shareholder engagement. So the PRI plays a very key role in bringing together our signatories. If you'll flip over to slide 26 and then 27, we bring together our signatories to engage collaboratively with companies on a range of ES&G issues. So slide 27 is a great example of that. There's an initiative called the Climate Action 100 Plus initiative. SFers is a member. BlackRock recently joined as well. And this is the world's largest collaborative engagement initiative on the topic of climate change. Over 400 investors representing over 37 trillion have come together to engage a group of 100 companies that together account for over 2/3 of global greenhouse gas emissions on a very specific set of asks that are being made to these companies. And when you bring that number of outstanding ownership together, the companies really start paying attention. And we've seen a lot of corporate commitments being made on climate change via this engagement initiative. I'll leave you with one more slide, slide 29. This is our PRI Academy, which is an online educational platform that offers CFA-accredited courses in responsible investment. We recently launched a 90-minute online course for trustees that is self-paced and is all about understanding what responsible investment is, its relevance to you as trustees, as fiduciaries, and ultimately how to integrate this into your plan. So I'll stop there and pass it over to Verity.
Thank you, and thank you for having me here today to talk about ESG integration. As Prabhu said, I've had about 17-year career in asset management, and half of that was in listed U.S. equities, and the other half has been in sustainable investment, which I'm going to talk about today. I'm currently a member of the BlackRock Sustainable Investing team focused on ESG integration. And my hope is that by talking to you today about sustainable investing at BlackRock, you'll be able to use our investment management firm as an example of what is happening across the investment management industry globally in response to this clear and consistent expectation from asset owners such as FERS and many others that as a fiduciary, which BlackRock is, managing assets of other owners, we are now just expected to be integrating ESG considerations into every investment decision, into every asset class, into every investment team. And that's what I want to tell you about today. So on the next page, you can see how we think about sustainability at BlackRock. It is a collaboration across many teams and encompasses many different activities. The BlackRock Sustainable Investment team is focused for the first three circles, focusing on generating investment insights in a research format, understanding the connection between ESG information and asset prices. We also collaborate with the investment teams to enhance their investment process. That's what we call ESG integration. We're also developing sustainable solutions. So those are investment offerings with dedicated ESG objectives. And our platform today amounts to about $90 billion in dedicated sustainable solutions of our total assets under management of $7 trillion. And so combined with investment process and sustainable solutions, we find ESG and sustainable investing applies to everything we do at BlackRock. So those first three circles are what our team focuses on, my team. We work very closely with the investment stewardship team at BlackRock. So as you've heard, that's the team that focuses on engagement with portfolio companies and also voting proxies for asset owners who delegate that authority to us. At BlackRock, we have more than 45 people dedicated to those activities, which we believe is the largest group of any asset manager. They're in local countries, they speak local language, which we think enhances that conversation in a collaborative, constructive way to achieve more outcomes. And finally, BlackRock has a corporate sustainability function, which is the acknowledgement that it's not only what we do in our day-to-day activities, we're also expected to walk our own talk. I'm going to talk about that in more detail, but before we leave this page, I just want to mention, we don't list the investment teams on this page, but they are absolutely central and critical to this effort of sustainability at BlackRock, and I'm going to talk about that a little bit later. So on the next slide is a quote from our BlackRock's CEO and chairman, Larry Fink, who writes a letter to CEOs every year. And January 14th, he made this letter publicly available on our website. And the big message here is, well, one of many important messages in this letter, which I really enjoyed reading personally, was the underlined idea that climate risk is investment risk. And a bigger picture that not all of the news outlets focus on was that this acknowledgement and sort of acceptance of this risk being a factual risk and worthy of investment decision makers' attention is really leading to a significant reallocation of capital. And on the next slide, I want to tell you what I mean by that. So this tectonic shift is really acknowledging and sort of an outcome of massive investor adoption of sustainability information and ESG information as relevant to the investment process, both on the asset manager side and the asset owner side, including public pensions such as yourselves. There's also a wealth shift to younger generations where there is a clear and persistent preference for activities such as sustainability that translates into corporate sustainability performance, which translates into which jobs younger people want to choose and which companies they want to work for. Along with that, there is a rapid acknowledgement of the risks presented by climate change that is now just being, it's an enormous problem. We all share it, and we just are now developing the tools and the data to analyze to understand the implications of this issue to our portfolios. And all of this is adding up to a massive reallocation of capital, which we think is establishing this sustainable risk premia. You heard about this a little bit earlier, but that kind of translates into the market favoring investments that are more sustainable, and therefore we need to make sure that our investments are more sustainable. It's sort of a virtuous loop. On the next slide, this is why sustainability is BlackRock's new standard of investing. So in a letter to clients that we issued in January 22, we announced a number of commitments that we plan to make that both sort of build off of things we've been doing for many years, as well as striving for new aspirations and harder goals for ourselves to achieve in order to take advantage and make sure our clients are well positioned vis-a-vis this reallocation of capital. So we are making sure that ESG funds are the standard building blocks in all of our standard offerings. That affects our sort of multi-asset strategies in particular and model portfolios. We are making sure that all active portfolio managers integrate ESG into their investment processes by 2020. That goes down to the fund level, and I'll talk about that more. Our stewardship team is raising the bar for disclosure with new commitments on describing the work they do and making sure that our clients are clear about the impacts from that work. We are also scrutinizing the highest ESG risk issues, including a focus first on thermal coal in our active strategies, as well as controversial weapons systems manufacturers. Those things that we find are just not offering a trade-off of value given the outsized risk. Our ETFs, we want to increase the amount of offerings there and disclose more sustainability characteristics, as well as expand options within index strategies and active strategies. So on the next slide, you see this adds up to really three main areas of focus: strengthening our integration in our investment process, increasing access to investment solutions that are aligned with sustainable investing objectives, both in index and active, as well as enhancing transparency. We want to make sure that investors and the general public understand what we mean. And as you've heard already, there's a lot of jargon in this space. It almost feels like that you have to learn a new language to understand what we mean by this, but I want to remind you, we're still talking about investing. So it's still about understanding activities to get comfortable with the opportunities that investments offer, as well as the risks involved. And then finally, we want to make sure that we're doing enough measurement of our own activities and description of those activities, because ultimately you manage what you measure. And we need to measure and report these activities of ESG integration all the way down to the specific strategy and fund level in order to contribute positively to this bigger question of a sustainable financial system, which we realize we are a part of, but all investors are a part of. So I want to tell you a little bit more about ESG integration, if you'll advance 2 slides, please. It's, as I said, you know, sustainable investing is still investing. But what we mean by ESG integration is looking at the same thing we're doing with a little bit of a different lens. So again, ESG information is still just information. So investors of all kinds of strategies take in important and relevant data points, metrics, reporting information. We think all of those investors ought to include environmental, social, and governance information in that broad bucket of information that makes a difference to investments. When we're talking about integration, we're talking about making sure it's embedded in the process. There are sort of 3 main areas of the investment process that are sort of common to any asset class and any style of investing, whether systematic or fundamental or you know, fixed income or equity. It's sort of a research and due diligence phase, it's a portfolio construction phase, and it's a portfolio monitoring and reviewing phase. And we find that ESG is relevant to all of those phases, and it's up to the investment team to make sure it fits in at the relevant place. And finally, where ESG can be a proxy for quality, it can also be a proxy for risk. And so we're making sure that we are understanding ESG as a risk, not only focusing on the highest ESG risk issues or business activities such as thermal coal, but also making sure that our team, a very important team at BlackRock called the Risk and Quantitative Analysis Team, or RQA, this Risk and Quantitative Analysis Team partners to they sit outside the investment team, but they collaborate and review portfolios on a regular basis to understand unintended bets and exposures, such as you know, a climate risk exposure that may not be intended in the objectives of the strategy. So that's a really important collaboration. On the next slide, you'll see at BlackRock, investors are responsible for ESG integration because it's about investment. So we do have a global executive committee that includes leaders from every investment division that oversee this activity. They oversee investment process, and they also oversee ESG integration into the investment process. And that's on purpose because it's relevant to the investment process. The team I sit on, the BlackRock Sustainable Investing team, serves as a kind of a coordinating platform team in order to make sure teams feel connected, and those that sit within an investment division can connect with people in a different investment division who might share a common problem. So for example, our alternatives division includes private credit teams, and they may have something to learn from the global fixed income division because they're both debt investors. We have a coalition of ESG integration partners that make sure this connectivity happens, but ultimately it's the investment professionals, the analysts and portfolio managers who are responsible and should be held accountable. And I invite you to ask any one of them, how do you integrate ESG into your strategy and your portfolio? On the next slide, you can see one of the efforts we're doing to coordinate this work is to make sure that we're evaluating investment teams to understand that they meet a minimum level of quality and credibility according to BlackRock standards, but that they're also continuously improving. We want every investment team at BlackRock to be continuously advancing. We want them to have an approach to ESG integration that is useful and therefore, adapted to their own investment process. And we continue to monitor these teams in order to strive and push for this continuous improvement. And one big switch we're making in 2020 is to move from evaluating teams, evaluating this ESG integration work at the investment team level, which could oversee many funds and portfolios, down to the strategy level, in order to really get to that granular level of accountability and the unique investment process for a given portfolio. So all of this work we do is for internal use. We do these evaluations to understand who was doing an excellent job and could be a source of learning and knowledge sharing across the firm, and who needs more help, more resources. And the information we glean from these evaluations is very valuable, but we don't make public. However, on the next slide, as a signatory to the PRI, you can go onto our website and read our PRI report. It's more than 200 pages, so please let me know if you do read it. I'll be very grateful for the time we spent doing that. But here you can see we also are willing to share our scores that are assessment scores from PRI about our PRI reporting. So in the right-hand column, you see our 2019 scores, and we were very proud that each one of these scores was either at median or above median. In fact, the vast majority of these scores are above our median peer group, which is asset managers with greater than $50 billion in assets under management. But what I really want you to take away from this table is the fact that we are working to increase our transparency over time by reporting to more asset classes, and we're also improving our scores over time. So we believe that as new data, new tools, new frameworks emerge, we're going to be smarter, we're going to be able to do more, and we want to be able to demonstrate that going forward. So this is just one other way that we disclose our approach to ESG integration, and it's one way you could understand how other managers are doing ESG integration by requesting their PRI reports and their assessments.
Don't worry, your report will not be 200 pages, I promise. They're a big firm.
Yes, you see here we're highly diversified, which means that because we are doing ESG integration in infrastructure and property and private equity and fixed income and listed equity and stewardship, we have a lot to say. And the top half is where we're managing assets directly in our funds, and the bottom half is where we're advising strategies. So we also have an advisory business where we recommend allocations to other funds, and we also include ESG considerations in manager selection through that advisory business. On the next slide, you'll see more about our commitments. So again, in 2020, in the spirit of continuous improvement and refinement and raising the bar on ourselves here, we started out at a team level focus in 2018, and this year we're really taking it to the fund level. And we're thinking about our work in ESG integration in three main buckets of activity. Really deepening our material insights, so that is understanding the ESG information that makes a difference, influences the investment decision, and making sure that we can not only have the climate risk tools and data to support that, but also facilitating this peer-to-peer learning, investor to investor, ultimately with the goal of having every investment team and investment professional be able to provide an example of how ESG information influences the investment decision. In the investment process, a really important step is to have that partnership with our risk and quantitative analysis team, and this focus on highest ESG holdings, highest ESG risk holdings. So we made a commitment for 2020 to exit all thermal coal positions, that is companies earning greater than 25% revenue from thermal coal activities from our active portfolios, as well as all holdings in our active portfolios of controversial weapons and civilian firearms. And then finally, we have a huge commitment to increasing and improving our transparency at the corporate level, at the investment level, and also in our investment stewardship team. This year, we plan to have every we plan to publish sustainability characteristics for every fund worldwide. And this will be available to the public as well as to clients. So on the next slide, I want to give you a little bit more of an example of, all of the, these are 4 examples. They're nearly chosen at random because we have examples from every investment division. But I want to illustrate here with this slide that we find a way to do ESG integration into investment research in fixed income, in active equities, also even in our cash portfolios. So your money market fund could include an ESG integration component, which is totally new. If you've been interested in following ESG, which maybe you haven't like I have, but the idea is that not only is this sustainable investing theory relevant for long-term investments like private equity, where you might have a 10 or 15-year commitment, and over that time scale, you can actually sort of see the physical effects of climate change come to realization, rising sea levels, decreasing coastline. But even in a portfolio with a 3-month time horizon, there's a way to think about ESG as being a value for understanding credit quality, with the idea that for corporate credits in a fixed income portfolio that is a cash portfolio, you would just not want to be owning the single stock that blows up during that 3-month period. So this is why it's just to illustrate that we find ESG is relevant for every asset class and every investment division at BlackRock. Want to just mention again that investment stewardship is the mechanism by which we manifest ESG integration for index strategies. So we're in index strategies where there's not that option to exit thermal coal, because if it's in the index, our obligation is to mirror that index. Our investment stewardship team can write letters and meet with directors on the board and meet with managers to understand how are you preparing your business to be relevant 15, 30 years from now, when we're still going to be invested on behalf of our clients. In the interest of time.
Excuse me,
Yes.
this is Trustee Jennings. I'm sorry to interrupt, but I'm really having a hard time hearing you.
Oh, I'm sorry, I'll make the microphone closer. I apologize. Is that better?
It's like cutting in and out. I don't know if it's your mic but again, I don't want to disturb. So.
Okay, I'm switching mics and standing a lot closer. I hope that helps. So in the interest of time, I want to mention that there is, on the slide, another trend from scarcity to superabundance of ESG data, a few slides ahead. And you've heard a little bit about company disclosure being more prolific than maybe 15 years ago. You've heard about unstructured big data, AI, and other methods of using information, including from, sort of EPA databases or Glassdoor ratings on good places to work. There are ways to get this information, as well as third-party research providers. But generally, there is a lack of reliable, comparable, decision-useful data. And so the next few pages talk a little bit about how we're taking the best of this available data set. But I want to flip ahead to the last slide, which talks about how we're working to improve the supply of investor-grade data. So, thinking about the bigger trend, the accounting profession and accounting rules have been around for hundreds of years. And financial reporting has been not only standardized, but regulated for decades. But that has not happened yet with the ESG data. So in order to increase the standardization, the reliability, and the comparability of solid environmental, social, and governance data of the quality that investors require in order to inform investment decisions, we are collaborating with a number of organizations, especially two listed here, the Task Force on Climate-Related Financial Disclosures, and SASB, the Sustainability Accounting Standards Board. And this table is meant to show you where they align and where they have specialties that help address certain needs. So the TCFD has a focus on climate risk, which is important. It goes deep into governance and strategy and risk understanding in order to understand not only what is climate risk doing to a potential business, but then what is the company going to do about it. It's getting past that sort of annual report boilerplate disclosure. Yes, climate change could affect our business. Well, tell us how and what you're going to do about it. That's what the TCFD is about. It is also global. It is also intended for investors. It has a financial materiality focus, and the scope of operations is global, which just means a company is not going to tell you about its favorite facility and low flush toilets there. It's going to tell you about its whole business and what climate change could do to that whole business. It is generally one set of recommendations for companies in all sectors, but there is some specialty and guidance for a few industries. SASB, in comparison, is also intended for investors. It also is global. It also has global operations as the scope. It also has this financial materiality standard of relevance for what should be reported, and that is determined by the companies who are reporting. But the difference is it includes broader sustainability issues. Climate change is definitely one of them, but also more of the human capital issues, which is the second most common theme of indicators included in the SASB standards, as well as having a difference of being industry specific, saying that what matters to companies in the asset management industry with a very small environmental footprint are very different to what mining companies should be paying attention to and disclosing to investors, acknowledging that it's not all the same for all companies, but many ESG issues are super industry specific and therefore more relevant to investors to be reported at the industry specific level. So we're very proud to be not only members of these two groups, but also now working on our own corporate reporting aligned with these two initiatives. So BlackRock put out its first SASB report earlier this year, and we are expecting to put out our first TCFD report later this year. And with that, turn it back to you, Prabhu.
Thank
We
you
have
all
some
again.
time for Q&A, Mr. Chairman?
Yes, yes, we do.
And again, thanks to all of our panelists for spending time. You don't have to be here, but you chose to be here to educate our boards. I do have two questions, but I'll let trustees go first.
I've got a question for you. It seems like this would be very applicable to your active strategies. Are you doing anything on your index strategies?
Yes, so at BlackRock, the mechanism for ESG integration into index strategies is through our stewardship activities. So that's the work that the team does, more than 45 members across the globe. They engage with companies owned in index funds, as well as active funds, but it primarily benefits these index funds where we don't have that option of selling. So the team can meet and hold accountable directors and other managers at portfolio companies and tell them, number one, our investors are making decisions. We expect this to be core to management and strategy. We expect you to disclose this information to the public, not just to BlackRock, but to the general public and all investors. And if you don't do that, we're going to vote against those we think are responsible for not only coming up with that strategy, but then also disclosing it, such as through SASB and TCFD aligned reports.
That's great, thank you.
Maybe one thing I'll just add to that, as an asset owner who, with a passive allocation, some pension funds, will be heavily tilted toward passive, this is where you are going to be able to ask your managers, tell us about your stewardship activities, tell us about your voting activities. There's a lot of differentiation there. So just wanted to plug that as well.
Thank you as well.
Hi all, thank you for the presentation. A lot of content there, a lot. Thank you. I wanted to ask you to elaborate just a little further because I think I'm hearing something that might be not quite aligned. So Sarah, you said something about if entities were to go down this road of incorporating further ESG, that there is a cost, and that seems to make a lot of sense to me, that there's a cost of commitment, time, and strategy. But then over here, there's a page that said, page 5 says there's no cost. So I think you're defining costs differently. So could you just clarify?
Yeah, that slide has been pointed out as confusing before. So I was talking specifically about the academic research that exists out there. Whereas Sarah was talking about, as a fund, what kind of resources will you be allocating to this? So maybe cost, is different, thought about differently there. Is that enough of a?
Yeah.
Okay.
Yeah, I just want to make sure.
Yeah, thanks.
But there could be a net benefit to the fund,
Correct.
because I would think that the cost of a staffer or two is going to be
Exactly.
far less than any alpha generated.
Hopefully, yes.
Exactly.
And I had one more for Andrew, actually. The work that you do around proxies, do you work with any single partner or multiple partners when you're looking at proxy vote and policy officially?
We do. We use Glass Lewis's research to inform our proxy voting. So we have a customized proxy voting policy. We have voting discretion over about 65% of our public equity investments. So those are where we invest in a separately managed account vehicle rather than a commingled fund. So we've developed those customized voting guidelines over the last 10 years or so. We use Glass Lewis's research to apply those.
Terrific, thank you.
Yep.
A couple of questions. Thank you again for this detailed presentation. I'm struck by the idea that there's very low correlation between different rating agencies who are rating the ESG performance. And that leads me to wonder what happens if there are varying ideas about what good ESG investment is. One thing is we might be subject to endless debate here on the board. And another, perhaps more relevant, is we would be subject to endless lobbying by outside groups to include or disinvest from various companies and or entire asset classes as a basis. So how do we implement a policy that is actually workable?
I'll start and welcome others to add on. It's a very insightful question, and you're 100% correct. In fact, the low correlation between ESG ratings manifests in two different things. First, I want to be clear, we're not calling them rating agencies. That term is something that is specific to the credit rating agencies, which allows them to see private information. And so these ESG research providers, because it's a research opinion, are telling us that they're providing their estimates and other research based on publicly available information, so that's really important. But because of this lack of correlation, what investors at BlackRock have found more useful is to go below that top line ESG rating into the sub-indicators. And that allows investors to really focus on the issues that they find more material, more relevant to their unique investment process, and also enables them to kind of pick and choose the sources that they find more useful across the varying different providers. So at BlackRock, we subscribe across our firm to more than 3 different ESG research providers and make those available in our Aladdin research investment and risk management platform to investors. But they can get the sub-indicator information that is more useful, more directional to their particular question, and our investors find that much, much more valuable.
I guess I was wondering what happens if they're actually at odds. For instance, I saw a debate last night where some people said fracking was very important as a interim energy source for the planet, and other people who are adamantly opposed to fracking. And then, of course, if we were to take a position on that here at the board,
Yeah.
there might be many people who are advocating one way or the other. How do we decide amongst competing visions of what good ESG is, regardless of what an outside vendor may rate them at?
Yeah, I mean, I think that's it's an important, very important consideration as the board, but also for the investment staff, to ensure that, again, as I said, all these decisions for us come back to what do we think is consistent with our fiduciary duty? What do we think is consistent with factors that drive risk and return for our plan? So for the most part, we try not to focus on binary outcomes around single issues or single practices, but really try to interrogate them through the same lens that we look at other information, we expect our investment managers to look at other information and exercise their professional judgment on whether a particular issue creates a risk or provides an opportunity. So when I think about something like the debate around fracking, I would approach that through an ESG lens and encourage our managers to approach it through that lens, to say that the mere fact that there's a debate, that it's coming up in a presidential debate, implies that there is some risk associated with that activity. Nobody knows how it may be regulated in the future, or how it may play out, but we would expect our managers to have some view on that risk, to account for the risk and the potential for there to be different outcomes on a particular issue. So we try not to predict the future or expect our managers to predict the future around these different ESG issues, but I guess cast a wide net of what could create a risk and be able to articulate how they are managing the risk posed.
And finally, you mentioned that according to a number of academic studies, there was in fact no cost to doing ESG, cost meaning reduced return.
Some studies do show cost. They're the the very minority of studies.
Right.
Yep.
But it's still a very young area, so I wonder if we,
Yeah.
first of all, I think we should certainly review those studies, but if we were to encounter studies that indicate the opposite, that there is a cost and a real cost, would it be in our fiduciary duty to pursue these ESG strategies? It would come at the direct cost of our members. They would be required to pay more into their pension plan if the pension plan isn't reducing the returns we had hoped and planned for, if we pursued strategies that were suboptimal.
So, go for it, Sarah.
I think a couple of areas is, first of all, across that broad range of ESG efforts, you focus on materiality. In other words, your financial, nobody knows the future, but what you see is potentially, and get your managers, both active and passive consultants, thinking about where these might potentially affect your long-term risk-adjusted returns. On your passive side, if it's in a commingled fund, which I believe you're managed through commingled funds, it's not going to change any of your investments. What you would be looking at is comparing one of your passive managers' proxy voting record for example, disclosure on climate risk or disclosure on exposure to energy transition risks or physical climate transition risks, comparing how those are to a similar passive manager who's going to charge you the same fees and give you the exact same market return. Those are kind of differentiators. May make a difference that you want to think about.
So, oh yeah, go
Yeah,
ahead.
I was just going to add that I think there's a really important distinction to be made between ESG-specific strategies and incorporating ESG factors into existing investment approaches and in strategies. And I think the body of academic literature that exists is wonderful. It's worth reading. Much of that focuses on the former, so using ESG data to guide investment strategies, or ESG tilted or ESG thematic strategies. There's more and newer emerging research that looks at how ESG issues and consideration of those risks and opportunities can inform or provide a fuller picture of risk and opportunity for an investor. So at Spurs, I'm not a portfolio manager. I work with all of our teams. We don't have a dedicated ESG portfolio or ESG strategy. We hold all of our managers, whether they incorporate ESG issues or don't incorporate ESG issues, to the same standards and expectations, and really are looking for managers that have conviction that consideration of these factors informs them and makes them better investors. There are other plans, and it's a valid approach to have an allocated ESG a bucket within your asset allocation or within a sub-asset class allocation. That's not the approach that we've followed. And I think that that's where you do have to have perhaps more conviction that a specific strategy that plays to an ESG theme or approach will generate a different risk-return profile for you than a comparable non-ESG strategy.
On that, I mean, you had a discussion earlier about passive versus active. If you're dedicating some ESG portfolio or fund, those are active manager decisions, and they're going to be at the same risk over values out of favor for the last decade. Those kind of things will be things you need to think about. That's a different level of incorporating environmental, social, and governance issues into your portfolio by asking your existing managers, are these risks for your active manager? Are these risks that you believe are material? If so, how do you manage them in your work for us? And on the passive side, are these important, critical issues that, how do you vote the proxies on? I used an example, disclosure, or 30% Coalition is looking at areas of diversity and inclusion, asking those managers how they're voting for, and then thinking about whether they make sense to you and comparing to their peers is a completely different level of integrating ESG. If you're going to start, let's divest from this or that or the other, or even tilt, you're making active manager decisions that you want to think about carefully.
It's really about understanding the risks, right? So fracking, I think Andrew pointed out, just the fact that it's being debated. But there's research. BlackRock's conducted internal research on climate factors. We have research on fracking, methane, what is best practice on reducing leakage, on protecting waterways, and the companies that are going to be better actors relative to their peers, those are going to be weighted more highly from an ESG scoring perspective. And that's where you get into not is fracking good or bad, but who are the better actors within that given sector or industry. On the academic research question, I think it's a great question. I wouldn't hang your fiduciary hat on the research for some of the reasons you mentioned. And to Andrew's point, you really have to look at each study and look at what it's looking at, what's the underlying methodology, and is it taking a lens of materiality? Is it looking at materiality at the company level, or is it a study focused on screening versus non-screening? And for that reason, I just wouldn't hang your hat on the research, but it is interesting. And for that reason, we have that repository I mentioned earlier, over 900 studies. You can filter them, you can look through them, and kind of find what you're interested in finding in terms of the specific type of study. On the manager due diligence side, the last thing I'll say real quick is this is where, again, you're assessing a manager's ability to manage these risks and their processes and policies for doing so. And this is where making use of the PRI reporting framework, right? Seeing online, we call it the data portal. You hop on there, you can find a specific manager, download what's called their transparency report, and look through how they've reported their ESG integration policies and practices. And this is where you also work with your consultant and see how they're rating their managers and using that data to do so.
Thank you, Prabhu. Thank you, everyone. It's been a magnificent presentation, a lot of information to digest. And so I apologize if the question is a bit naive. I think mostly directed to Andrew. Andrew, San Francisco, is that correct? Has the plan attempted or measure the results of implementing the concept in the portfolio over time? And if so, has it added value or not? Or is that something or is that something that is not really relevant to the plan goals in terms of implementing that approach?
It's a very good question and something, we're wrestling with. And I think the short answer is, no, we don't have a quantitative way to measure the impact of our ESG platform on the overall plan results. We're looking at ways that we can try to do that, and there's emerging tools that can sort of use ESG as a potential factor. It's not an established risk premia right now, but people are looking at it through that lens. But I think for all the reasons we've talked about, it's because it touches on so many aspects of investment management, from manager selection to the due diligence, to things we screen out of our portfolio, to strategies we may opportunistically invest in around renewable energy, for example. It's going to be really hard to quantify it. So in some ways, we think about my role and function sort of parallel to our risk and asset allocation function. And so we can't necessarily quantify the value add from the function, but we generally have an understanding that it's important to consider these factors. One thing we have measured and we've begun to measure is the impact of excluding sectors from our investment universe. And on an overall basis, that's actually been negative to our performance due to our exclusion of the tobacco sector in 1998 and the compounding effects of that over time. Our other investment exclusions on an additive basis have actually been positive to the performance. But that's, again, one narrow slice of our overall strategy.
Thank you.
Of course. Well, I'm going to hold off my question for the March 5th meeting in the interest of time. But again, I want to thank our panelists, notwithstanding what the president says, climate change is real. I believe in it. And I want to thank the board, because you've been very patient for 3 hours. There's been 2 heavy education sessions. But I think these are important topics, both asset allocation and ESG. And you will have to make those decisions in the months ahead. So again, thank you for your patience. Thanks to the panel.
Thank you.
Yes,
Thank you very much.
Thank you very
everyone.
much.
And thank you again, Mr. Polani, for coordinating and getting this in front of us. Okay, we're going to go on now to item 4A, oral update from the CEO, Retirement Services, Mr. Pena.
Thank you, Mr. Chair. So a couple of things. I finally reached out to the city, our city staff liaison, Cheryl Parkman. As you know, we have an annual meeting jointly of the boards with the city council. It has been completed the last 2 years and on the April-May timeline. So just wanted to kind of kick it off, let you know that we are starting conversations, so they will be reaching out to the city council to see when, in terms of timelines, when some days may be available, and then I will bring that back to you boards just so we can coordinate timing and topics for discussion. I will be going to the city council on April 7th to present the results of the work by Chiron on the actual evaluations for June 30, 2019. Also wanted to share with you that we just issued an RFP for legal services, all kind of legal services, whether it's general, fiduciary, disability, tax, and everything else. And that went out. It was posted last Friday, February 14th, and I believe it's going to be, it will close on Monday, March 16th. The timeline and the goal is to be able to do the diligence work and come back to you boards for the month of June for approval, so that we can kick off new agreements in the July 1st, 2020 timeline. And in closing, I wanted to let you know that a couple of weeks ago, as part of the implementation of the pension administration system, we issue member direct letters. We issue member direct letters about a month ago to retirees, to allow them access to the new system, so they can look at information, do calculations, and find all kind of sort of information. And we just issue the same type of letters to our active members. And so, so again, so they can access the data directly at the system and get some information and do some estimates themselves. And I think we're still working through the process, but I think it has been very successful, especially the direct letters to active members, because we use the work that we did with the retirees to learn from our mistakes so that we could make the second letter a little easier to understand. And next week, we're going to be issuing the annual members statements for the pension plans to our members. And in closing, I wanted to share with you that Seagull company actually acquired LRWL. For those of you that don't know, LRWL is the consulting firm that actually did our work with staff and help us on managing the pension administration system work and implementation over the last 5 years. And so now LRWL is part of the Seagull company. That concludes my statements, Mr. Chair, so I'm happy to answer any questions.
Quick question, Mr. Peña.
Yes.
You mentioned the joint meeting between the board and city council. Does that happen at a regular board meeting, or is that a separate scheduled time?
It will be most likely a separate scheduled time.
And that's both boards.
Yeah.
Yes.
It's Police and Fire Federated and the City Council. And it's right here.
Oh, all three?
Yeah.
Yes,
Okay,
yes.
so that's got to get everybody on board.
Other questions for Mr. Peña? Okay, thank you very much. Item 4B, oral update from the City Council liaison to the board. Council member?
Thank you. Oh, I got the bum one, I think. So we are doing priority setting on Tuesday, and that kind of kicks off the council activity in terms of the 2021 budget process. The mayor actually had his budget town hall last Thursday with neighborhood leaders, just to kind of kick off the process and get some initial feedback. I'm just looking at the budget calendar so that you will know the city manager's budget request, including our 5-year forecast, will be released at the end of this month, so it should be next week, Friday. And then we'll get the mayor's budget message the following week, and then we'll hear it the week after that at council. So that's kind of where we are at the beginning of the budget process.
Thank you,
Thank you.
Councilmember. So, Mr. Shea, if you allow me, because of Councilmember comments, it reminded me to let you know, we plan to come before both of the boards next month to present our request for the administrative budget for the 2021 fiscal year. So again, we're going to be going the first week to Police and Fire, and on the third week in March to Federated. And I also wanted to share with you, this is just tentative. It hasn't been scheduled, but I just got an email from Sheriff Parkman, who is sitting at the audience. Tentatively, April 13th, as of right now, may be the day for the joint meeting. That hasn't been addressed. I don't know to what extent the city clerk has actually reached out to the council members, but that's the first day that has been mentioned. We will continue working on the timeline, and we'll keep, I'm sure, the city will keep the city council apprised, and I will keep both boards apprised. Thank you. Oh, one last comment. Since you're here, Cheryl, thank you. Can you comment to the board on the work and the timeline for the implementation of the CalPERS defined benefit plan for the investment professionals?
Hi, everyone. I'm Cheryl Parkman. I work in the Office of Employee Relations. For the new trustees on the board, there are some investment professionals who are not included in the city's defined benefit plan. That was through a recommendation from a previous board governance report. So we've been requested to add these particular individuals, those who were hired on or after November 4th, 2014, to a CalPERS defined benefit plan. We are working with CalPERS on a timeline right now. to be taken to City Council for two different things, one to approve a resolution and another to approve an ordinance, which is a municipal code change. We are right now generally estimating that everything will be done by middle of May of this year. So there is a nice, end in sight for this, and we're happy to report that.
Thank you, Cheryl.
You're very welcome.
And now that concludes my opening,
All right,
Mr.
thank
Chair,
you.
so I apologize.
Thank you very much. Okay, let's go on to item 4C, discussion and action on adoption of the resolution 9092, cost of living adjustment rate for 415B qualified participants under the grandfather rule. So I am going to recuse myself from participation in this item 4C due to my involvement in the 415 lawsuit. And though the topics are not related, I do choose to avoid even the appearance of impropriety. Trustee Sun has graciously agreed to chair this item, and I will step out of the room and wait for word to, that it's okay for me to return.
So I was told that the CEO will introduce this topic to the board.
Well, thank you, Trustee Sun. Actually, and I will just pass that along to our Deputy Director, Barbara Heyman, who actually will be introducing the discussion for the,
So
for this
this
item.
memo is from staff, and it is concerning the setting the COLA rate for 415B qualified participants. As of today, usually the COLA rate is at 3% annual, but for qualified participants, for 415B qualified participants, as defined by the IRC, the allowance that someone gets cannot be below what they would have received under the system rules as of October 14th, 1987. And as of that time, the COLA was applied using the CPI. And so for those that are affected by 415B, we'll recalculate their benefit using the CPI for every single year. And at that time, the board would adopt the CPI rate and set it. And so for last year, the CPI rate was 2.5, and which is below the 3%. And so those members can also use 0.5 from prior year's excess accumulations. And so this resolution is setting the COLA rate for those members at 2.5 and a 0.5 that can be used from prior year's accumulation.
So that means in total there will be 3%?
If they had enough in their bank, they could draw from it to bring it up to that 3%, capped at 3.
Also, every participant is different.
That
So
is true,
that's
depending
good.
on when they
Retire.
retired, yes.
Okay. Any more questions and comments? Okay. Do we have a motion for this item? Item 4C.
I'd motion to approve.
Do you have a second?
I'll second.
Great. Then follow the example of chair. I will call individual trustee for a vote. First, Trustee Keller,
Aye.
Trustee Orr,
Aye.
Trustee Horowitz.
Aye.
I'm also agree to aye too. Great. There's
Trustee Jennings?
Trustee Jennings.
Okay,
Sorry.
aye.
So this item 4C is approved. Can we call Jay back?
Yes.
Thank you.
You here? Yeah, we're back. We forgot about Trustee Jennings again, but they finally, we asked her, yes.
Yeah, I'm still here, guys.
Yes, yes, thank you.
Okay, moving on then to.
Oh, I have a quick question. So on this resolution, I seem to recall this coming up before. Do we do this annually? when
We
they-
do this annually.
We do the cut as to what the CPI. and
That is
the
correct. The
indexes-
CPI is on the calendar year basis, and
Thank you.
we need to do this on the annual basis, yes. Thank you.
Trustee Sun, thank you for doing that. Item 5, committee reports, recommendations. 5.1, Investment Committee. Last meeting was January 28th. Next meeting is March 24. An oral update from the Chair of the Investment Committee. Trustee Chandra's not here. Trustee Orr.
Yeah, happy to just a quick comment. So that was the first meeting. It kicked off with all of us, the three of us, including some staff. We agreed that at the next meeting on the 24th, we'll be focusing on strategic asset allocation as a priority. And then the asset actual policy and the investment consultant reviews will be diarized onto the upcoming board meetings, which I'll leave to someone else to reconfirm those dates so I don't misspeak.
Okay. 5.1B, minutes of the October 22nd Federated IC meeting, receive and file. 5C, minutes of the October 22nd Joint Investment Committee, receive and file. 5.2, Governance Committee, last meeting was December 5, and next meeting is March 5. Is there an oral update from the chair?
Unfortunately, I was not yet assigned to the governance committee at that time, so I have nothing to report.
But we have no updates at this point. We're just going to be, we provided an update last time, and the next meeting is next month.
Okay, very good, thank you. 5.3, Audit Committee, last meeting was October 17, and the next meeting is February 20th. Is there an update from the Chair of the Audit Committee?
I'm sure Trustee Kelleher won't be able to provide you with an update, as he wasn't even a trustee of the board. But he will have an update for you at your March meeting for today's meeting after the board meeting, that's for sure.
Wonderful.
But just so to remind the board, at the last meeting, October 17, the main discussion was around the presentation of the CAFRs and the acceptance of the report by Grant Thornton and their review for,
Yes.
For the Federated Board.
Yes, thank you. Okay, 5.4, Joint Personnel Committee, and we do know should read Castellano, Chandra, and Orr, per the committee assignments approved at last month's board meeting. Last meeting was October 28. Next meeting is February 25, and we do not have an oral update on that one.
We do not, but I do wanted to take this opportunity, if you allow me, Mr. Chair, a couple of things. The meeting is on Tuesday from 10 to 12 at our office's 5th floor. This is the only real joint meeting of the boards on committees, and so it requires quorum from both, from each side of the equation, so 2 out of the 3 for Federated and 2 out of the 3 for Police and Fire. In your case, we already know that Trustee Chandra won't be able to attend, so I'm going to ask Trustee Orr and Castellano, to let us know if something comes out that you cannot make it, let us know, because we will have to cancel the meeting, and I certainly hope that you both can make it on Tuesday.
Confirm.
Thank you.
Same here. Okay. Item 6, Education and Training. 6A is the Cortex report. 6B is Calipers Program Calendar. 6C is Calipers Program Assembly. D, Calipers Advanced Principles for Management Trustees. E, SACRS Spring 2020 Conference. SACRS, F is SACRS UC Berkeley program, and G is SACRS Fall 2020 Conference. Any future agenda items? Are there any public retiree comments from this audience? And are there any members of the public present at the teleconference location who wish to address the board?
No.
Okay. Well, with that, we are adjourned. Thank you, everybody.